In this presentation, we will take a look at the process of putting together a statement of cash flows. This will be a long presentation. If you would like to jump to relevant points within it, take a look at the description below, which will have links to those relevant points as well as a description of what will be included at those points. We'll also have links to other related financial accounting videos. In this presentation, we will introduce the financial statement of cash flows. When thinking about the statement of cash flows, we want to compare and contrast the reasons for it to what the other financial statements are providing us. What information, in other words, are we going to get from the statement of cash flows that's not on the other financial statements, those being the balance sheet, the income statement, the statement of equity. We're mainly comparing against the income statement because the statement of cash flows is going to give us some similar information. It's going to give us information over time, what's happening over time, unlike the balance sheet, which is going to have a point in time. So we're still looking at timing, what is going on over time. That's typically our income statement, which measures performance. The major goal of the income statement is to measure performance. How have we done? How much work have we done? Revenue minus expenses, revenue being recognized when we earn the work, when we've done the job, expenses when we've incurred something in order to help generate in the same time period. And that's going to be the net income. What that doesn't do, however, is measure cash flow. And when we first learn about the income statement, that's going to be a real big distinction we want to look at. We want to say, okay, the income statement's on an accrual basis. Why? Because that's better for performance measurement. It's better for us to see how much work we did. And a cash flow basis doesn't tell us that very well. That's why we have to use an accrual basis. However, cash flow is very important. And if we do not report it on the income statement in terms of cash flow, then we need the statement of cash flows in order to give us that added information. So really, the statement of cash flows can be compared in a lot of ways to the income statement. It's going to measure performance, but it's also going to measure other types of cash flows outside of things that we would think about as income statement type of activities. But it's going to be a timing statement, and it's going to give us those cash flows. So it's going to tell us the sources of cash inflows. Now, of course, note that as we work in the company, any type of business, most things are going to go through cash. Any cycle, whether it be a payable cycle or a revenue cycle, is going to deal with cash at some point within the process. So cash flow is going to be important, and we want to know what the sources of the cash flow are. Hopefully, a lot of it will be from revenue from customers that we're going to have the cash flow, but we could have other sources of revenues too, including loans or investments from the owners. We want to know the sources of the outflows. What are we spending cash on? Typically, we would think expenses, inventory, but possibly paying down loans and other types of things that the cash is going out for. And then, of course, the reasons for change in cash, because when we look at the financial statements, we're oftentimes going to look at what's the bottom line on the income statement? What's our net income? And we're going to look at the balance sheet, and then we're going to look at cash. What's changing in cash? Do we have enough cash for us to, continue with the operations? Do we have more than enough cash, and possibly we can give out a dividend or draw some money out for personal use? So this change in cash, not the same thing as net income. However, very important, statement of cash flow will give us that information so that we can have the best of both worlds. We can have the income statement giving us performance data, and we can have the statement of cash flows giving us the cash flow data. This is going to be really important, and it's something that whenever we first start learning the accrual basis often comes to mind. When we learn the accrual basis and we learn that we're going to have the income statement reporting revenue when it's earned, not necessarily when we get the cash, and expenses when they're incurred, not actually when we pay them, then we often start thinking, well, that's going to distort things in terms of cash flow because we may be recognizing revenue before we get cash. And so we often, when learning the accrual basis, are asking these questions in terms of, what about cash flow? Isn't that important? I need to know what the actual cash flow is. And by doing the statement of cash flows, we get the best of both worlds because the income statement will measure better the actual performance on an accrual basis. That's a better measurement of what we're actually doing. And the cash flow statement will give us those cash flows and tell us where the resources of cash are, where the cash is coming from, where the cash is going, what the change in cash is due to. So in order to do this, we first then need to think about what is cash. Now, clearly, when we think about a company, most of the time it's going to be the checking account, possibly the savings account. But there could be other types of accounts because we may have more than just one checking account. We may have multiple checking accounts. We'd have to include all of the checking accounts in terms of what cash is going to be. And then we've got cash equivalents. We could have some things that are going to be highly liquid, very close to cash, that may be included in cash as well. So short-term, highly liquid investments, things that can be converted into cash very quickly, possibly would then be cash equivalents and included in our statement of cash flows. Easily convertible into cash, things are going to be changed to cash very easily. Close to maturity so that the market value is not affected by interest rate changes. So if something is really close to maturity, then we're going to say, okay, it's pretty close to cash because it's right next to the maturity. And therefore, we're going to include it in cash on the balance sheet, and we're going to be using it within the statement of cash flows to look at the change in cash. In this presentation, we will take a look at classifications of cash flows on the statement of cash flows. There's going to be three major categories on the statement of cash flows. Those will be operating activities, investing activities, and financing activities. So our goal here when we go through the statement of cash flow, as we work through the statement of cash flows, is going to be in part to decide which area these cash flows should go. Should they go into operating, investing, or financing? It's going to be common questions and common problems, and really just information we need to know when reading the statement of cash flows. So we'll start off with the operating activities. We're just going to look at the major components of the cash flows within the operating activities. So we'll talk about inflows and outflows. Remember, what we're talking about here is cash. So when we're talking about the statement of cash flows, we're talking about cash flows, the cash that goes into the company, the cash that goes out of the company. We're going to talk about inflows and outflows here related to operating activities. Before we go into the list of inflows and outflows related to operating activities, we want to know first that operating activities is going to be similar to us thinking about the income statement on a cash basis. So when we think about the operating activities, we're really thinking, or one way to think about it would be that if we were to have the income statement on a cash basis, then what would the inflows and outflows be? That'll basically be what are in the operating activities. When we get to the thought process in terms of how to determine operating, investing, and financing activities, we'll go more through that in the thought process. But just note, operating activities you want to tie out in some way to income statement on not an accrual basis, as is a normal income statement, but a cash basis. So any kind of sales then, of course, would be the operating activities, the sales related to cash sales or sales from collection on credit sales. So in other words, that would be sales from a cash flow basis. That would be the major component of the operating activities. And that would include the sales that would be cash sales that we made now and sales that we collected on. So if we made a sale in the past, say last month we made a sale, or last year, let's say we made a sale on account, we did the work, recorded revenue last year, but we got the cash this year from the accounts receivable. We reduced accounts receivable and recorded the revenue this year. Recorded the cash when we got the cash this time. Well, from a cash flow statement, of course, the cash was received now, this year, even though the work was done last year. So that would be, from a cash flow perspective, cash flow this year from the sale that happened last year. On the outflow side, we'd have payments for operating expenses. So that would be the typical outflow. And again, you can think of it as a comparison to the income statement, where we would record the expense when we incur it in accordance with the matching principle. But here, of course, we're talking cash flows. And so the expenses that we have, similar to the income statement, we're going to record them here when the cash goes out, whether they be for expenses that we paid at the same time as we consumed the expense, or if they went through accounts payable, meaning, for example, if last year we paid for an expense and then we didn't pay for it last year, we put it on account. We had an expense that we put on account into accounts payable and paid for it this year because we're paying off the payable, then that would be included in the cash flow this year, although it would not be an expense because we recorded the expense last year when we incurred the expense, not when we paid for it. So you can see that relationship here. These are going to be items that are in the revenue cycle, meaning revenue and income and expenses are going to be our typical cash flows for the operating activities. However, on a cash basis rather than an accrual basis, we're kind of converting the accrual basis to a cash basis for the operating activities. Now, those two ways that we can do that with a direct method and an indirect method. We'll talk about that later, but just note now that when we talk about those two methods, they apply only to the operating activities. Now we're going to go to the investing activities. Same things, inflows and outflows for investing activities. Now note that when we look at cash inflows and outflows, we're hoping that most of the activity, like a lot of the action that's happening, is probably going to be in the operating activities because that's what our normal operations are. But we have other type of activities that will be dealing with other areas, income, investment activities, and financing activities. And these are the things you might want to think about in terms of the way I would think about it is, if you think of the normal journal entry related to something, is there an income statement account involved in it? If it is, then you probably have something dealing with an operating activity. If not, then you probably have something dealing with investing or in financing. So we'll talk more about that later, but just get an idea of that now. So sales of property, plant, and equipment. This is often one that was confusing when I first learned the statement of cash flows because property, plant, and equipment is going to be an asset, and we're using the term investment activities here. So note that when you think about investments, you may be thinking, like I used to, of just stocks and bonds as like the types of investments, and property, plant, and investments is a fixed asset. It's not in the same category, but in another sense it is. You know, all assets that we have on the balance sheet are investments in a sense, because that's why we bought them. We bought them in order to help us generate revenue in the future. They're not helping us generate revenue now. That's why they're assets. That's why they're on the books as assets. We're investing in them now. We put the cash, we got the cash, we left the cash, we spent the cash, and we got something else. We didn't expend it now. We didn't get an expense and consume something. We got an investment, in this case in property, plant, and equipment. So you could see the journal entry. If we were to buy it with cash, we would credit cash, debit property, plant, and equipment, an asset. Neither of those two accounts are income statement accounts. Even if we financed it and got a loan, it would be a liability. So therefore, it's not going to be an operating activity. That's one way you can think about it and say, probably not an operating. That would leave you with investing or financing. And it's going to be an investing activity because we're investing in the equipment. And then we have the sale of long-term investments. So if we have an investment on the books as an investment, possibly stocks, then we could sell the investment, and then that would be an investing activity as well. That's probably one that would come to mind as an investing type of activity if we bought and sold our long-term investments. If we go to the outflows then, we have the purchase of intangible assets, and we've got the purchase of property, plant, and equipment. So once again, note that anything dealing with property, plant, and equipment is going to be on the investments portion. And you can think of that journal entry again. What's going to be the major journal entries related to property, plant, and equipment? Well, we buy it, which would be a debit to property, plant, and equipment, credit to cash, possibly a credit to notes as well to finance it. None of them have to do with the income statement, and therefore it's going to be something else, either investing or financing, in this case investing. Or you can just memorize property, plant, and equipment is going to be investing. We're investing in something. When we sell the property, plant, and equipment also, we're going to debit cash and we're going to credit property, plant, and equipment. Now we might have a gain or loss, and you might think, well, that's kind of a, what do we do with that? That's on the income statement. But really the main components are going to be balance sheet type of accounts there. We'll talk about the gain or loss when we get to that information. But note that anything dealing with property, plant, and equipment typically will be investing, whether we be buying it or selling it. And then we have the purchase of investments, and once again, that would be more of an investing activity, clearly, because we're purchasing investments, possibly stocks or bonds that we're investing into, and that would be part of the investing activities. Then we have the financing activities. The final component we'll be taking a look at. We've taken a look at operating, investing, and now financing. That's going to include issue of common and preferred stock. So when we issue stock, that's going to be something that deals with the owner. So the owners, we're issuing the stock to the owners. It's kind of like an initial investment from the owner. So that's going to be a financing type of activity. And then we have the reissuing of treasury stock. So if we had the treasury stock, financing activity, and then the issue of debt. So if we had debt that we're going to be dealing with, then also financing activity. Note that these types of entries, again, don't deal with anything on the income statement typically. When we have the inflow for the issuance of stock, for example, we would be debiting the cash, but not crediting income. We would be crediting common stock or additional paid in cash and or additional paid in capital. So there's no income statement account involved in that. So typically we would say, okay, it's not going to be operating, and therefore it needs to be something with investing or financing. And these two, note, we're not dealing with anything in terms of an asset. We're not giving the cash away to buy an asset that we're investing into the future. We're financing the company. The point of this is to get the cash in the company, to get capital, to get cash, and or paying back that capital or cash that we used to finance the company in the past. So that's going to be the financing activities. Then we have the outflows, or owner's contributions as well. So note here, when we have the contributions, if it's a corporation, that would be the common stock. We would issue common stock. That would be like an owner investment because we would be getting more owner investment. If we're sole proprietorship or partnership, then the owners would be investing their money back into the company, and we would debit cash and credit their capital account, another type of owner investment for that type of business entity. And then we've got the paying dividends. So when we pay back the dividends, that's going to be part of the financing activities. And note again, what's happening here is we're crediting cash and we're debiting retained earnings or dividends. Neither of those two things are dealing with the income statement, and neither of them are dealing with something we're investing in terms of an asset. They're part of the financing activities. And then we have the purchase of treasury stock and the pay with withdrawals. These two are similar again, this being for a corporation when we pay the owners back, this being for a sole proprietorship or partnership when we pay the owners back. And then when we pay the debt, when we pay off the debt, same type of activity. Again, neither of the accounts, we're going to credit cash to pay off. We're going to debit a liability, the note payable, to pay off. So it's not typically operating, it's typically going to be financing. In this presentation, we will think about the thought process to know which category a cash flow should be entered into, whether it should be operating, investing, or a financing activity. When putting together the statement of cash flows, we're usually going to have a worksheet which will typically have a comparison of balance sheet accounts. And we also might just have test questions that will ask us, where should this cash flow go? And that's going to be a common kind of question that we're going to have, whether we build the entire cash flow statement from scratch or whether we're just asking test questions and trying to know what types of cash flows we're talking about. It's also important for practice as well, so that we can understand when we're thinking about cash flows, where do they belong? What do these cash flows mean? What are they doing for us? What are they doing for the company? Are they part of the operations? Are they part of investing? Are they part of financing? If we look at a worksheet like this to build the statement of cash flow, typically we're going to look at a balance sheet for 2 periods. So here's our balance sheet for these 2 periods, and we'll have the difference between the 2 periods in terms of the balance for these balance sheet accounts. So we've got cash, accounts receivable, inventory, prepaid expenses. Now what we're going to do is we're going to take the change in cash, that's going to be the end result on our statement of cash flows. And we're going to kind of back in to that end result by looking at the change in the other balance sheet accounts and try to figure out what's causing this change. So we're going to go through all the other balance sheet accounts, look through these changes, and we know that if we add them all up, they add up to 0. Why? Because the debits and credits for one year add up to 0. The debits and credits for the other year add up to 0. In other words, the debits minus the credits equals 0. And therefore, the difference between the 2 years, debits and credits, the change, will add up to 0. So we know that's the case, and we know that if we add up then everything except cash, then the result will be the difference in cash. So that's how we're going to kind of work and put together our statement of cash flows. So what we need to do then is we're going to take a look at these changes in receivables, changes in inventory, changes in prepaid expenses, and then try to determine where does that change belong. before we get into any other question, is the change of inventory an operating, investing, or financing activity? And is the change in long-term notes payable, is that going to be an operating, investing, or financing activity? Our goal here is to go through a thought process to see if we can think through more clearly which category these should belong to. So what's the most common journal entry in this account? It's going to be our first question. Whatever account they're giving us here, we're going to say, let's think about the most common journal entry that's related to this account. There's typically going to be 1 or 2 journal entries that are going to be very common, and we want to just write that down first. Once we know the most common journal entry, then we're going to ask, is an income statement account involved? So when we think about whatever account we're dealing with, we'd write down the journal entry and say, okay, is there an income statement account involved? Is there a revenue account or an expense account involved? If the answer is yes, then it's probably the change that we're dealing with is probably something that should be in the operating activities. Because remember, the operating activities is kind of like the income statement on a cash basis. So if we're dealing with something this change has something to do with the income statement, then it's going to be something on the operating activities typically. If the journal entry has nothing to do with the income statement, there's no revenue or expense accounts involved in the normal journal entries related to these accounts, then we're going to ask the question, are we purchasing or selling an asset? Because so if it's not operating, this means that it's not operating. Therefore, we're trying to see if it's going to be investing activity. And that typically means we're purchasing or selling an asset. If it has to do with, for example, property, plant, and equipment, or some other type of investment, then it's going to be an investing activity. And then if it's not, then it's going to be financing. And of course, financing is going to be dealing with notes, something that we're dealing with that doesn't deal with operating activities in terms of the income statement, no revenue and expenses, and typically doesn't have assets involved either, because what we're doing is funding the company. So that's typically going to be something that deals with cash and some type of liability or the equity section. So this is going to be our thought process. If we go through each of those line items and think about each account on the balance sheet, and then try to go through this thought process and think, okay, which category are we going to be putting this change to? Now, this looks a little less intuitive than we might think at first glance here, because note, what we're doing here, looking at the balance sheet accounts, and we're trying to see what category these things are going to fit into. And remember that the operating activities, I keep on comparing that to the income statement. And you might be thinking, well, these are all balance sheet accounts. Why do you keep mentioning the income statement? And note what we're doing here is we're really kind of backing into the activity is happening by looking at the change in 2 points in time. So we're kind of still looking at the income statement activity type of accounts. We're looking at change. We're looking at activity, even though we're doing that by looking at the change in 2 points in time, 2 balance sheet accounts, which are points in time. So when we look at the change in accounts receivable, for example, if we go through our thought process, we're going to say, okay, accounts receivable was at $80,750 in the prior year. End of the current year, it's at $77,100. That means it went down by $3,650. So our goal here is just to determine which category that change belongs to. Is it operating, investing, or financing? And if we think about that, then we can think, well, what's the normal journal entry related to accounts receivable? We're going to have a debit to accounts receivable and a credit to sales. That's going to be our normal journal entry that we'll have related to accounts receivable. And we can see there that sales is an income statement account. So we know that is an income statement account involved? We're going to say yes. Therefore, it's an operating activity. So note what we're doing here. We're looking at the change in a balance sheet account. We're looking at the change in the balance sheet account. Then ask yourself, what's the normal journal entry related to this account? And if we think about the normal journal entry related to accounts receivable, that's a sale of something on account. So accounts receivable goes up when we make a sale on account and we credit revenue. And revenue is clearly an income statement account. So this change then, that's what we're going to think through. We're going to say, that change looks like it belongs somewhere in the operating activities, because we're really kind of backing into sales. That's what we're really looking at. And we're going to do that by writing down the journal entry. Let's look at another account. We're going to pick equipment now. So we're just going to go through all these changes, and we just got to find a home for all these changes when we make the statement of cash flows. We got to find a home for them in either operating, investing, or financing, and we'll end up with the change in cash, which is kind of like the bottom line. The bottom line will be cash at the end of the day. So we got to find a home for the equipment. Where's that going to go, that change? Well, if we think about the journal entry for equipment, then if we buy equipment, we're going to debit equipment and credit cash, and possibly credit like a note payable, some type of financing. But if we paid cash for it, this would be the most simplified journal entry. Even if we had a note, there'd be no part of it that would be on the income statement. One asset went up, the other asset is going down. So therefore, is an income statement account involved? No. So we're purchasing, so it's not going to be an operating activity. And then the next question is, are we purchasing or selling an asset? In this case, yeah, we're purchasing an asset. And that means that it's going to be an investing activity. So, and this was the confusing thing for me when I first started learning this thing, because investing activities, I had a different conception of what investing is to investing in something like any asset. Anything we purchase in the business that we're not consuming now is an investment to the future in terms of the cash flow statement. We're trying to spend our cash in order to put our money somewhere that's going to help us make money in the future. That's going to be some type of investment. So in this case, it's going to be an investing activity. In this presentation, we will take a look at a basic outline for a statement of cash flows. In order to do this, we first want to give an idea of how the statement of cash flows will be generated, so we can think about these components of the statement of cash flows and where they come from. Typically, we will have a worksheet such as this that we will use in order to generate the statement of cash flows. That statement of cash flows having three major components: operating activities, investing activities, and financing activities. Our goal here is going to be to fill out these three components, and typically we will use a worksheet such as this on the left. The worksheet is just basically a comparative balance sheet that we have here that we've reformatted from a balance sheet to just a trial balance type format, a debit and credit type format. So you can see that we have our balance sheet accounts, and we are in balance by having the debits be positive and the credits be negative, or debits minus the credits equaling 0, given it's an indication that this period, the current period that we are working on, is in balance. The prior period, same thing. So we have 2 points in time for 2 balance sheet points: the prior year or period, the prior year in this case, and the current year. And then we just took the difference between these two columns. And if we have something that's in balance here, the debits minus the credits equals 0. Something that's in balance here, the debits minus the credits equals 0. And then we take the difference of each line item in these columns and sum up those differences. It too must add up to 0. So in essence, what we're going to do in order to create the statement of cash flows is find a home for all these differences. And that'll give us a cash flow, a concept of the cash flow statement. We'll get into more detail on how to do that when we create the cash flow statement, but as we look at the outline, keep that in mind. So here's going to be the basic outline for the statement of cash flows. We're going to have the operating activities. That's going to include a list of inflows and outflows from the operating activities. And then we're going to have the net cash provided by the operating activities. Now, this list of inflows and outflows for the operating activity will be the most extensive list, because the operating activities are in relation to, you can think of it as similar to the income statement for an accrual basis. What we're trying to do is get to net cash provided by operating activities, which is kind of like net income on a cash basis. So that means that most of the activities that we do is going to be here, because that's normally what the reporting is in terms of activity. That's what the income statement does. It reports activity, as opposed to the balance sheet, which reports where we are at a certain point in time. So then we have the other investing activities. Those will include inflows and outflows. There's going to be less involved in the investing activities. And of course, those will include investments, like if we were to invest in stocks and bonds or something like that. But they also include investments in assets like fixed assets, like property, plant, and equipment. So we just got to be aware of that in the investing activities. Property, plant, and equipment will be there. Typically going to be less activity that goes on in the investing activities than, of course, in the operating activities. Then we've got the financing activities, and those are we're going to list the inflows and outflows of the financing activities. And those are going to be things that are usually just to get capital in the business or to pay back capital or pay back the owners. So these are going to be things like loans related to loans, taking out a loan, or getting money from the owner, whether that be from selling stock in the company, issuing stock, or if it's a sole proprietorship or partnership, the owner just putting money into the company, or paying back money, such as debts, or paying back money to the owners like dividends or draws. So those are going to be the three categories we're going to have. And when we put the information into these three categories, we got to think about our worksheet that we saw in the prior slide and think, okay, where are each of these activities going to go? Are each of these areas going to be operating, investing, or financing? So whenever we think about the cash flow statement, we always want to be thinking operating, investing, and financing, and which area do these whatever cash flows we have fit into. And we'll discuss a thought process on how to do that. We'll put together a cash flow statement in order to help us do that. We have the typical kind of format when we put together a cash flow statement of any kind of statement, whereas we subtotal it on the inner column, and then we list the accounts in the inner column, and then we give a subtotal. So we're going to list out the activity for operating activities, and then give the subtotal in the outer column. These two columns are not going to be debit and credit related. It's a financial statement. We don't deal with debits and credits on the financial statement. It's a plus and minus financial statement. So these two columns simply deal with, this is going to be a list of the subcategory, and this is the summary of the subcategory, and that's going to be it. And then if we have these outer columns, net cash provided by operating activities, cash provided by investing activities, and cash provided. Dang it. In this presentation, we will take a look at an outline of the statement of cash flows. In order to understand the outline for the statement of cash flows, we want to get a quick example of how we're going to format the statement of cash flows. We're going to take something like this worksheet on the left side, and we're going to be putting this information into the three categories of the statement of cash flows: operating activities, investing activities, financing activities. We'll get into more detail about this worksheet, but it's a good idea to just have some preliminary notion of this concept as we look through the outline of the statement of cash flows. This is basically going to be a comparative balance sheet that we've put back into a debit and credit format that we have here, and we have the current period and the prior period. We can see that we are in balance because the debits minus the credits equals 0 for the current period, debits minus the credits equals 0 for the prior period, and then we're basically taking the difference between each of these line items. And that gives us the difference for each line item on the balance sheet accounts. And if this column debits and credits equals 0 and this column debits and credits equals 0, then the difference will also equal 0. Now what we're going to do in the statement of cash flows is really just going to take each of these categories and we're going to find a home for them. So our question is always going to be these categories here, which kind of represent cash flow, and we'll talk about more how that can be. How can we tie, what does this mean in terms of cash flow? How does this tie into cash flow? We'll talk more about that. But once we look at each of these cash flows areas, we then need to determine, are these going to be areas that are going to go to the operating activities, investing activities, or financing activities? So let's take a look at an outline of a statement of cash flow so we can see how this will look in terms of a financial statement format. We're going to have operating activities. That'll be the top of our statement of cash flows. It's kind of like where most of the information will be. The operating activities are just going to have a list of inflows and outflows, and then we're going to have net cash provided or used by operating activities. Notice we have some generic terminology here because the terms will differ if we have a cash inflow or a cash outflow. Now hopefully in the operating activities we have a cash inflow because this is going to be the major types of activities of the company. So typically here we'll have a cash inflow, and we're going to say provided by, cash provided by, because cash hopefully went up. However, if there's a cash outflow, if there's a decrease in cash for the time period, which is possible, we're going to use the term used in. So notice that when we make a kind of a generic format, a generic worksheet, we're basically going to use the terminology both provided by and used in so that we can format our worksheet. The operating activities is really where most of the information should be, because the operating activities is similar to an income statement that has been flipped from an accrual basis to a cash basis. So net cash provided by operating activities is kind of like net income on a cash basis. Because this is an activity statement, this is reporting activity over time, it's similar to the income statement, and therefore this section should be where the most of the activity will be. Then we're going to have investing activities, and we're going to list inflows and outflows, and then we'll have net cash provided or used by investing activities. Same format that we're going to have here. There should be far fewer investing activities, however. Obviously, that'll deal with like investing if we were to invest as a company in stocks and bonds, but it also deals with investment in long-term assets such as property, plant, and equipment that will go into the investing activities. Then we will have the financing activities, same concept, listing inflows and outflows of the financing activities. And then we'll have the net cash provided or used in the financing activities. So our major goal when we think about the cash flow statement and we have questions about cash flow is usually which of these categories is it going to belong in. When we think about a cash flow, is it operating? Is it investing? Is it financing? We will go through a thought process in a later presentation in terms of can we best determine whether something is operating, investing, or financing. And note that the default is obviously always going to be operating as our first kind of question. Is it operating? If it's not operating, then is it investing? And then is it financing? Operating having to do with cash flows related to similar transactions as the income statement. So if we're talking about a cash flow that deals with something that would be a normal operation, revenue and expenses related, but cash flow related to them, probably operating. Investing activities, going to be dealing with the investments in stocks and bonds and things like that, normal types of things we think of as investments, but also having to do with investments in long-term fixed assets like property, plant, and equipment. Financing activities having to do with things that we're using to finance the company. We're trying to generate capital, money in the company that we can use to run the business, or we're paying back capital or money to run the business. So if we're taking out a loan, or if we're issuing stock, or we're getting money from investors, or we're paying back a loan, we're paying back the investors with dividends or draws. Once we have this information, you can note that the normal format is similar to any financial statement. We're going to group this information in the inner column. So this is a subcategory of operating activities. We'll list all the operating activities in the inner column, and then we'll total them up in the outer column. So these two columns do not represent debits and credits like any financial statement. They're not going to show debits and credits because we don't want to have to explain debits and credits to normal readers of the financial statements. So we're going to convert the debits and credits into a plus and minus format. And then we're going to have these two columns be the subtotals. So that means these totals in the outer column then, this is going to be net cash provided or used in operating activities, net cash provided or used in investing, and net cash provided or used in financing. If we add or subtract those up, whichever way they be going in terms of cash flow, then we're going to get the net cash increase or decrease in cash, net increase or decrease in cash. That's going to be these three items here. This is really what we're looking for in the statement of cash flows because this is the activity. This is what happened. We're looking for that change in cash. Cash has changed. How did it change? Well, here's the story of how it changed in terms of these summary stories, operating, investing, and financing. And then here's the more detail in terms of those three categories of what happened, what's going on with this change. But we don't want to just report this cash change because if we did so, then readers of the financial statement would have to do some math in order to tie everything out. They'd have to subtract the comparative balance sheet cash on the first period to the next period to see what the change is to make sure that this number ties out to it. And we would like to have something at the bottom of the cash flow statement that readers can tie out easily and say, okay, I see how these two statements are related. So what we'll do is we'll take this change and we'll add to it the cash balance at the prior period end. So we're going to say, here's the difference, here's what changed, here's what the cash was at the beginning of the time period, which is the same as the end of the last time period. And then that'll give us cash flow at the end of the period. So then this cash flow then is what will tie out to the balance sheet. So it'll match what's on the balance sheet. So again, this is really what we're looking for. We're looking for the change, the activity, what's going on. But we want to tie it out to the bottom line number on the balance sheet. So people have a very easy check. They can just go right to this bottom line number and say, okay, yeah, that matches the balance sheet. It looks like this whole thing ties out. I see where this fits in. If we think about this in relation to our worksheet, which we had basically two time periods, a comparative balance sheet here, current period, prior period, then we could see that this whole activity down here matches up with our activity up top. Remember, we have the current period information, prior period, the difference. We're really looking for that difference because that's showing the activity. That's going to be here. But then we're going to tie it out to our cash at the end of the time period because that's what will be reported on the balance sheet. So we'll get into this worksheet more as we go through. We're really going to be working with this differences column in order to help us determine what the cash flows from operating activities, investing activities, and financing activities will be. In this presentation, we will take a look at the tools needed in order to complete a statement of cash flows. To complete a statement of cash flows, we are typically going to need a comparative balance sheet. That's going to include a balance sheet from the prior period, whether that be the prior month or the prior year, and a balance sheet from the current period. Then we're going to have an income statement, and then we'll need some additional information. In a book problem, it'll typically give us some additional information, often having to do with things like was there equipment purchases, were there equipment purchases or equipment sales, were there investments in the company, were there sales of stocks, what were the dividends within the company. In practice, of course, we would have to just know and recognize those types of areas where we might need more detail, and we would get that additional information with general ledger. We'd go into the general ledger, look at that added information. Now, once we have this information, our major component we're going to use is going to be the comparative balance sheet. That's where we will start. So the comparative balance sheet is going to be used to make a worksheet such as this. This may seem unusual considering we're talking about a cash flow statement. We're talking about activity. We're talking about things that are happening over time. And that usually you would think correlate to the income statement because that's also something that would be happening over time. But what we're going to do is kind of back into the activity that's happening over time by looking at the change, by looking at the difference between 2 points in time. So what we will typically do is take our balance sheet and put it into just a worksheet. This worksheet is more of a trial balance type. It looks like a post-closing trial balance for 2 years, in this case, 2 periods. We can see that the debits are positive, the credits are negative for this worksheet. Debits minus credits equals 0. So that means that the debits equal the credits for this year, the debits equal the credits for the second year, and if we take the difference between the two, then the change will have a change that will be equal to 0. So this is going to be the type of worksheet we'll put together from the balance sheet in order to then move forward. Now, of course, this will give us a lot of the information we're going to use. This is the primary worksheet. These differences don't represent balance sheet accounts as of a point in time. What they really represent is the change, what happened, what's going on over time. And therefore, these differences really result in income statement type of activity, the income statement reporting, the change oftentimes with many of these accounts. So this is going to be the primary thing that we will look at. Now, when we go to some of these items, however, we're going to say, maybe we don't have enough detail. For example, if we look at the change in retained earnings, most of that's going to be net income is going to be the change from retained earnings. But we could have also had some other things happen. We could have had, for example, dividends that were paid or something like that. So some of these type of accounts, the same is going to be with equipment. So if we see a change in equipment, well, that could have been a purchase, but there might have been a loan that was on the equipment or some other things as well. So the change in accumulated depreciation is typically going to be depreciation expense. But there might be some other things like a sale of equipment or a purchase that can throw that off as well. So we're just going to note those things, and we're going to look at the income statement to verify some of them. For example, the change in retained earnings should equal, if it's net income, that's on the income statement, and we can determine that. And if it's not net income, then we can look at retained earnings and see what else is included in the GL other than retained earnings to make up this change. if the change in equipment is not just a cash purchase of equipment, something else happened, if there's multiple purchases or if there's a loan, we can go to the GL and look at that activity and then pull out the loan documents, because not too much activity should be in the equipment account. We should only purchase a few things. We didn't purchase things every day in the equipment account. And the same for accumulated depreciation. If the change happens to not be what is on the income statement for depreciation expense, as you would think the change for accumulated depreciation would be, we can then go to the income statement and say, is that what depreciation expense is? Is it equal to this change in accumulated depreciation? If it is, fine, and we'll use that number. If it's not, then we got to go into the GL and say, okay, was there a sale of equipment or something else that would happen that's going to throw off or make us do something different? So that's going to get into the alternative information that we're going to be needing. So tools we'll need: balance sheet for the 2 time periods, the prior period and the current period, for which we can use to create a worksheet such as this. Income statement to give us some more detail about some of these changes in the numbers, more of the story. And then additional information. In a book problem, they'll just give us additional information. In real life, we would go through some of these changes and say, is this, can I check this out by looking at the GL, looking at some additional information that may be needed to verify a couple numbers that we pretty much get used to verifying as we do a few of these cash flow statements. In this presentation, we will take a look at strategies for thinking about the statement of cash flows and how we will approach the statement of cash flows. When considering the statement of cash flows, we typically look at a worksheet or put together a worksheet such as this from a comparative balance sheet, that giving the balance sheet accounts for the current year and the prior year, or the current period and the prior period, and then giving us the difference between those accounts. So we have the cash, we've got the accounts receivable, inventory. We're representing this in debits and credits. So this is in essence going to be a post-closing trial balance, one with just the balance sheet accounts, the debits represented with positive and the credits represented with negative numbers in this worksheet. So the debits minus the credits equals 0 for the current year, the prior year. And then if we take the difference between all the accounts and we were to add them up, then that's going to equal 0 as well. This will be the worksheet that we're thinking about. Now, when considering the statement of cash flows, we can think about the statement of cash flows in a few different ways. We know that this, of course, is the change in cash. This is the time period in the current time period, the prior year, in this case, the prior period. The difference between those two is the difference in cash. That's the change in cash. That's kind of like the bottom line of the statement of cash flows, meaning we're really looking for this change in cash. We're going to end the statement of cash flows by getting back to this cash at the end of the time period so that it'll tie out to the balance sheet. But we're really looking for the activity, the change. That's what the statement of cash flows is designed to do. So to think about that, let's go through, we could think of the GL and just look at the GL for the cash flow. Now, of course, the GL for a cash flow is going to be a lot of activity. That's why the cash flow statement is so important, because cash is going to be involved in so many activities. It's involved in every cycle. We deal with cash transactions every day. So when we see the GL, we know that it's going to be increasing with debits. We know that it's going to be decreasing with credits. And we know that if we looked at the entire GL for most companies, it would be very long, it'd be very extensive. But we can see all this activity, and we can see that we can, if we're trying to look at the cash flow, one way we can do that is, of course, to look at the activity within the cash flow statement, within the GL, and we can think about trying to categorize those. That would be one approach to figuring out what is happening within the cash flow. We can go through the actual cash flow statement, the GL, and try to categorize all the activity, because we know that this activity, of course, represents the change here. That represents the difference of what's happening from one period to the next. So this will give us our ending balance. So we know then that this ending balance is going to equal what's on the balance sheet. And we know that if we added up all this activity, that's going to give us the change. And this is really what we're looking for the statement of cash flow. So when we consider the statement of cash flows, you could think of it, well, what we're really getting after here is looking at all the changes in the GL and try to categorize those changes into basic categories in terms of operating, investing, and financing type of activities. So that's one way we can approach this and think about this. Now, We don't typically do it this way when we do the cash flow statement because it's too tedious to do that. To go through each activity again, we'd basically be kind of recreating the entire books on a cash flow basis. And so we can think about it this way in theory, and then in practice, we typically do something a little bit different. We kind of back into this information. And we do that by noting the accounting equation of assets equal liabilities plus equity, and just kind of breaking out the cash component to it. So in our worksheet, we can see that if this is the change in cash, this is the number we're really looking for, then we could look at the change in everything else, and that'll back into the change in cash. In other words, we know that the debits equal the credits here, so the change in cash is equal to the change in everything else, or the change in everything adds up to 0. And therefore, everything else other than cash, the change in everything else other than cash, will add up to the change in cash. And by doing this, we can see a kind of a grouping a little bit more easily, rather than looking through every transaction in the GL, because there'll be a lot of transactions, for example, that make up this difference in accounts receivable. But we don't need to look at every transaction because they're all pretty much the same. We know what happens with accounts receivable. It goes up when we make a sale on account, and accounts receivable is going to go down when a customer pays off the account. So we don't need to look at every single transactions within there as we would do if we saw it in the GL. We can kind of group those together and say, that difference here, and we can take that as a whole and try to think about what's the net that happened in terms of accounts receivable and back into what happened. We'll talk more about how to do that on each individual account, but just note the theory here of what we're doing is we're backing into the cash flow statement. And that may seem confusing at first in theory, because if you're looking at the change or the activity in the cash flow, you would think you would be looking directly at the GL as we did in the prior slide. You'd think we would go to the activity in the GL and try to recategorize them in terms of cash flows, in terms of categories operating, investing, and financing. But what we're really going to do typically is use an equation more like this. We're going to say here the accounting equation is assets equal liabilities plus equity. Then we're going to break out cash and say, then we can say, cash plus all other non-cash assets. So we're saying this, keeping this one alone, cash, versus all non-cash assets will equal liabilities plus equity. And so we're working with this formula to break out cash. And by doing that, we can look at the cash flow and we can kind of back in to the cash flow. So these are the two ways, they're kind of the opposite ways we can look at it. We can go in and we can look at the activity that's happening to cash itself, which is a bit of a tedious job in practice, although in theory it makes the most sense. It makes the most sense to say, hey, we want to know what's happening with cash. Let's look at the GL and recategorize everything that happened in cash. But what is more practical in practice is to use the equation and really look at everything else other than cash in these groupings of categories, which is what this worksheet will in essence do. And by doing that, we're going to back into what the changes in cash are happening. So that's how the cash flow statement will typically be working, with something more like this, using this accounting equation, using this worksheet reflecting what this accounting equation is saying. In this presentation, we will compare and contrast the direct method versus the indirect method for the statement of cash flows. It's important to note that when we're comparing the direct and indirect methods, we're really only talking about the top part, the operating activities portion of the statement of cash flows. In other words, the investing activities and financing activities and end result will remain the same. We're going to end up at the same result, which of course will be the ending cash that we can tie out to the balance sheet, and we'll have the change of cash here, which is really kind of what we're looking for in the statement of cash flows. What's going to differ is the operating activities. Why are they going to differ? Why would we have the operating activities differ? Remember that the operating activities have to do with kind of the income statement. You can think of it basically as the income statement being reformatted to a cash flow statement versus an accrual statement. So the income statement that we use is on an accrual basis, and we recognize revenue when it's earned rather than when cash is received, expenses when expenses are incurred rather than when cash is paid. That's going to be on an accrual basis. If we were to convert that to something that would be on a cash basis, that would be similar to something that would be on the cash flow statement just for the operating activities. So there are now the operating activities is usually the longest part of the statement, because when we tell the story of what's happening within a company, whether that be through activities in terms of income statement, what's happening in terms of normal operations, or through a cash flow statement, what's happening through cash flow. We typically are, most of the transactions then, most of the detail, most of the story is going to be in the operating activities section. So this is usually the largest section, in other words. But there are other things here, the investing and financing, where we could have cash flows that are not part of the kind of the income statement section, the normal operating type of activities section. So we're going to compare and contrast this. Now, the direct method then makes more sense to us, or at least intuitively it makes more sense, because that would be similar to us going through the income statement line by line and just fixing it so that like sales or revenue would be reported on a cash flow basis rather than on a revenue recognition basis, from a cash basis rather than an accrual basis. That makes sense. However, note that we've already calculated net income on a accrual basis. And so in a sense, it'd be easier for us, and it might make more sense in terms of just tying out the two, seeing the difference, to start with net income and then reverse the things that are not related to cash. And that's the indirect method. So oftentimes, we will often use actually the indirect method, the less intuitive method, for a few different reasons. One, it could be required. It's often required to have the indirect method. And two, which is probably the reason why we were required to have an indirect method, because you might think, why would we want that method when the other method seems more straightforward? If I was to explain to someone how this works, if I looked at the indirect versus the direct method, I think it would be easier to look at the direct method here to say, hey, if we're trying to explain to an investor, this is the cash flow from operations. This is similar to the income statement. We're going to take cash received from customers, cash paid for merchandise, cash paid for other operating expenses, cash paid for taxes. And you can see that these kind of list out and line up in a similar fashion as you might see on an income statement. This is the direct method, the method that typically may not be the most used. And even if we do use the direct method, oftentimes we're still required to have an indirect method calculation. And the indirect method is more difficult to explain to most people typically, because it starts with net income, and then we kind of back out these changes, which makes sense, but it's a little confusing to think about these changes, and we'll get into a lot more detail on why this works and how these changes are going to be adjusted. The bottom line, of course, will remain the same, so we end up in the same total. It's just the different approaches that we're going to get to that total. Now, why would we do this? I mean, this makes more sense just intuitively. Why would we require, if someone did the direct method, to then do the indirect method as well? Well, it might be useful for us to see this reconciliation, because we'd want to know what is the difference between net income and the cash flow from operations. We want to know those reconciling items. So when we do the direct method, it's nice because we've reconstructed everything line by line, and we can kind of compare line by line the income statement versus the cash flow statement in terms of the operating activities. But this method, the indirect method, gives us kind of the exact difference, the changes, the reconciliation between net income on an accrual basis and the cash flows from operations, which is kind of like net income from a cash flow basis. So for this reason, typically, in order to if we're trying to not do as little work as possible, right, not have the two statements, then a lot of times we'll see the indirect method and not have the direct method. So a lot of textbooks will focus, and a lot of companies, and will focus oftentimes on the indirect method a lot, because it's typically going to be the required method, and therefore the method that will be used, and the method that gives a lot of information for us. So remember that the direct method is going to basically reline out everything. So we're going to say the income statement starts with revenue. We're now going to say it's going to be cash received from customers. And therefore, the difference between those two, we'll have to look at and we'll talk more about this when we do the direct method, but we'll have to look at the revenue account and decide what's a cash revenue basis. What would be recorded as revenue if we were on a cash flow basis rather than an accrual basis. And we'll do the same for other components of the statement of cash flow, of the income statement. And then in the indirect method, we're going to go over here and start with net income, the bottom line on the income statement. And then we're going to reverse things out that are not cash related. For example, depreciation, a gain or a loss, are not cash related. We'll talk more about that when we construct the indirect method cash flow statement. And then we've got the differences from accounts receivable, inventory, prepaid expenses, and we'll talk more about where these differences come from. Why are these not cash related? And to do that, we're going to have to think about these accounts and say, how do they go up or down, and then reverse these out. Now, doing this is going to be really helpful to us to just understand normal accrual accounting. If you can understand, the cash flow statement and make one, then you're really kind of reconstructing the accrual basis and thinking about the accrual basis versus the cash basis. So even if you don't plan on making a lot of cash flow statements, the practice of doing so really helps for us to understand, different accounts, what different accounts are doing, and the difference between a cash basis and an accrual basis. In this presentation, we will put together a worksheet that will then be used to create the statement of cash flows using the indirect method. To do this, we're going to use our resources, which will include a comparative balance sheet, an income statement, and added information. Remember that in practice, we're typically going to have a comparative balance sheet, ours here being for the current year, 2000X5, and 2000X4, the prior year. So we need a comparative 2 time periods in order to create our worksheet. This will be the primary component that we'll use to create our worksheet. We will need the income statement when creating the statement of cash flows, mainly to check up on some of the differences that we will have in our worksheet. And then in a book problem, we'll typically be told some other things related to, for example, purchases or sales of equipment, borrowings, if we had any cash dividends or any dividends at all. This is added information we would need. In practice, of course, we would just be checking on these things by looking at the difference and going back to the GL and just taking a look at those differences in order to determine if we have any added information that needs to be adjusted on our statement of cash flows. So now we're going to take our difference in the comparative balance sheet and create our worksheet. Now, some people will just take this comparative balance sheet and just take the difference between it. But it's easier to kind of put it into a worksheet and to put it into more of a trial balance worksheet. In other words, to put it into a post-closing trial balance type worksheet. So I'm going to do the opposite of what we typically do when we create the balance sheet. And that is to take it from a plus and minus balance sheet, as we see here, to a debit and credit format trial balance. So we're going to take everything that we have here, the end result, and we're going to try to convert it into like a trial balance type result. By doing that, it'll be a lot easier for us to do the calculations on the worksheet. What we're going to do is have a plus and minus or a debit and credit type worksheet, which will make it easier for us to do the calculations, and we'll eliminate some of these subtotals. We don't need this total current assets. We don't need the subtotal for property, plant, and equipment. Total assets, we don't need the current liabilities or total liabilities. So we'll remove those subtitles by making the worksheet. So we're just going to go line by line, and again, we're not going to start with assets, we're not going to start with current assets, we're just going to start with the account of cash, and we're going to say, okay, 2000X5, 123,450, and 2000X4, 61,550, and then of course we will subtract those two, and we'll get to the difference, the change here being the 61,900, which is going to be this number minus this number. The change is increasing, of course, because we can see the change. And as we go to debits and credits, we kind of got to just interpret the change and see what happened. Of course, this is the prior number, here's the current number. That means it went up. This change is an increase. But we're representing these kind of in debits and credits, so we need to be careful to make that conversion. So then we're just going to go to accounts receivable, same thing. We're just going to pull these over into our worksheet. The 180,750, 2000 X4 and X5. If we subtract the two out, then we're going to add the difference here, and that's going to be 3,650. In this case, of course, it went down. We decreased in this account. Then we're going to have the inventory. So the inventory is another asset. We're just pulling over these two numbers. Started at 240,600, or it started at 250,700, went down to 240,600, decrease of 10,100. And then we're going to go to prepaid expenses. We're just going right down the line here. Was at 17,000, now at 15,100, decrease 1,900. Then we're going to skip down to equipment. We're not going to add the subtotals or another subcategory. We're going to go down to equipment. It's another asset. Started at 200,000, went up to 262,250, change 62,250. Then we'll go to the accumulated depreciation, a little bit tricky because it's a credit balance account, it's a contra asset account. So when we convert it from a plus and minus to a debit and credit, I'm going to put brackets around it here to represent the fact that it's going to be a credit. So it started at 95,000, went up to 110,750. This 15,750 is an increase because it's an increase in the credit direction. So you got to be kind of careful when we look at these worksheets to set it up and make sure we understand what these signs are saying. And the only way to get good at that is just to practice, keep on doing the worksheets so you can get good at knowing what's the difference between a debit and credit and a plus and minus, and how can we use the two and still use math without getting the two concepts confused. And the cash flow statement is really good for learning that, because no matter how you set it up, we gotta get those differences down. And then we've got the accounts payable. So same thing, these are liabilities now. So it started at 102,000 and then it ended at 17,750. So that's a decrease. So it decreased it in the debit direction. 84,250 went down in this case. Then we've got the short-term payable, started at 10,000, went up to 15, increase with a credit of 5,000. And then we have the long-term, started at 77.5, increased to 100,000, increase of 22.5. Common stock, so note we're skipping the subtotals, not adding the subtotals, we're down to the common stock. It started at 200, it's a credit again, so we're converting these common stock to a credit, 200,000. Ended at 215, increase in the credit direction, 15,000. And then we got additional paid in capital from here, started at 0, went up 30, so that's a change of 30, increase. And then we've got retained earnings. So here's retained earnings. It's a credit too, it's in the equity section, 125,500. Went to 230,000, increased by 104,500. And again, we're not going to have the subtotals here, so that's going to be the entire thing. Then we can easily see if we did this correctly by, if we have in Excel, if we have the positive numbers, or if we just add these up, if we have the debits being positive and the credits being negative, we take the debits minus the credits, and if they're equal, then we'll end up with 0. And that's going to be the beauty of this worksheet, of course, because we can easily see that, well, if we're starting with something that ended up debits and credits equal 0, and we're ending with something that the debits and credits equal 0, and then we're taking the difference going the same way each time, which we can do in Excel with just a formula, or we can do it with a calculator, and then we know that the change will equal 0. Now this worksheet, if you spend some time with this worksheet, it'll give you a good understanding of where we're going to start with the creation of the statement of cash flows. So here's kind of an end result type worksheet of the statement of cash flows. We've got the cash flows from operating activities, cash flows from investing activities, cash flows from financing activities. We're going to start this process by basically just looking at each of these differences and finding a home for them in the statement of cash flows. And you can think of it just as a puzzle at this point in time. We know this. We know that the difference right here, 61.9, is going to be represented as the increase or change here. And we know that these two cash numbers are going to get to the difference here. So this is going to be our ending cash at the end of the time period. Where really this is kind of like the bottom line though. This is really kind of the bottom line because that's the change. That's what's happening to cash. That's going to be the change in cash. So we already knew that the end result because it's on the balance sheet. The reason we want to get to it on the statement of cash flow is simply so that we can tie it out to the balance sheet. But this amount tying out to the worksheet is giving us that change, and that's really kind of what we're looking for when we're looking at a statement of cash flow. It's an activity statement. So we know that that is going to be the bottom line, and we know that this whole thing adds up to 0 if I was to add up all these changes. So that means that if this is the bottom line, then if we find a home for everything except that, then the difference is going to be this, meaning if I was to say this minus this, or if I was to add up this whole column, debits minus the credits, or the positive numbers minus the negative numbers, then it would add up to the 61,900. We know that has to be the case because we can just see it mathematically. That has to work. So all we need to do to start the statement of cash flows is to take all these changes that we have and find a home for them here in a plus and minus format. So we're just reformatting these numbers, just putting them into a different format. So that's all we really have to do. Now, it is a little bit more complex from that. I would do this in a two-step process, and this is what I'm going to argue to do, is to first find a home for all these without getting into any more detail, without looking at the added resources of the problem, just so you start with something that's in balance, and then go back and look at the additional information and make changes. So I would argue to do that in a two-step process in a problem like this. Let's figure this out. Let's find a home for these. And then any added information that makes these more complicated, we'll get into the detail. Why would that happen? Like, for example, if the equipment here, or let's say the accumulated depreciation, the change in accumulated depreciation should be depreciation expense right here. But notice it's not. And if we went to the balance sheet, or the income statement, we would see it's that the change is not exactly what the depreciation expense is as we would expect. And so what we would have to do is figure out what else happened. There must have been a sale of equipment or something like that that resulted in that change being different. And we'll have to go back and deal with that. But I would argue that first, we're just going to put this in the change for the depreciation and then go back and figure that out. Because when we figure out the detail, what we're really doing is taking this change and we're breaking it out into multiple categories. And so that's going to complicate things. So it's easier to kind of figure the thing out, make it work with just these numbers, knowing that you're going to have to give more detail to some of them. They're not completely correct, and then break out the ones you need to as you recognize them as we go. That'll be the process we will use. In this presentation, we will start to construct the statement of cash flows using the indirect method, focusing in on cash and net income. This is going to be the resources we will have. We'll have the comparative balance sheet, the income statement, and we're going to have some added information in order to construct the statement of cash flows. We're mainly going to be working with a worksheet that was put together from a comparative balance sheet. That's where we will start. So we're going to find a home. This is going to be our worksheet. We have the two periods. So we have the current year, we've got the prior year, and we've got the difference between those activities. Now, our goal here is to basically just find a home for every component on this difference section. So that's going to be our home. Why? Well, we can first start thinking about cash. What are we going to do with cash? That's the main thing. This is a statement of cash flows here. So where are we going to put cash? That's actually going to start at the bottom. We're going to say that's going to be our end number. Our end number, we know it's going to be cash. Now, we're going to recalculate it, but it's useful for us to just know, and we might just want to put there, hey, that's where we're going to end up. That's where we are looking to get. And now what we really want is the change, however, the difference, the 61,900, because that's the activity. That's what's happening over time. So we get there with the statement of cash flows by basically having the increase in cash, or the increase or decrease, whatever it happens to be. It happens to be an increase for this activity because cash went up, but it could be a decrease, but whatever it will be, we have here. That's the change we're looking for. Now, this would be all we would really need to tie out to our worksheet. But, of course, we want to tie it out to the balance sheet. We want the statement of cash flows to tie out to the balance sheet. So that's why these last two numbers on the statement of cash flows are really just to kind of get us to the balance sheet number so that we don't have to like tie out this change to the change in the comparative balance sheet. Like we could stop here and provide a comparative balance sheet and people would have to know to tie out to make sure everything works. They could take the difference between cash and see that this is the change in cash. But it's easier for us to show everybody that it works by having the ending cash at the end of the current year. So to do that, we're going to take the change and then we're going to add to it the beginning cash to get the cash at the end of the year. This is the amount on the balance sheet. But this is really the amount, this change that we're looking for here. That's going to give us the activity. Now that of course is represented here on our differences within our worksheet. That's going to be our major difference. Now we're going to calculate it not by just taking this difference here as we did here. We just took that difference and said that's where we want to end up. But we're going to do that by taking every other place and finding a home for it. So we're going to recalculate this number, but it's useful to see where we start. So notice what we did in this worksheet. We're taking each account and we have like basically a post-closing trial balance for the current period and the prior period. and then we took the difference between each of them. And we could see that it's in a debit and credit type format, and the debits equal the credits represented by this green 0, meaning debits minus the credits equals 0. That's what this means here. And therefore, if we find a home for everything except the cash difference, then we'll end up with the cash difference. So that's going to be what we are looking for, and that'll be the end point, the 61,900. So we will recalculate that by finding a home for everything else. Now the place where we start to do that is going to be the change typically in retained earnings, which we call net income. That's usually where we start in a statement of cash flows. Now there's a couple different ways we could do this. We could just go line by line and say where do each of these belong? Or we can try to do what typically most people do, is really start with the cash flows from operating and then go down from there. So that's what we will start with here. We're going to say the net income then is typically going to be this change in retained earnings. Now, note that this isn't quite right. I'm going to recognize that right now. We're going to say that doesn't happen to equal what net income is. This change in retained earnings doesn't equal what net income is, but it's part of it. And I'm going to argue that the goal right now is going to be for us to go through this entire thing and find a home for all of these changes without breaking them up. There's going to be added information that we know that happens to deal with dividends here that's going to be broken out. So that's why this doesn't exactly equal net income. But rather than getting all complicated and starting to break all these out into multiple components of this change, it's easier for us to find a home for all of these changes first, get to the correct number, 61,900, the change in cash, after finding a home for all of these numbers, and then go back and say, okay, are any of these numbers, do we have to break it out and give us more detail? So what we're going to do is actually start here with 104,500, recognizing that that's not net income, but that we'll have to go back and break that out so that we don't complicate things in the beginning. So how do we know that that 104,500 isn't net income? Well, if we look at the income statement, we can see that the income statement is the 158,100. So we would clearly look at the income statement and say that's not the difference. But we're not going to take the difference from the income statement because that doesn't work with our worksheet, right? Our worksheet is here to find a home for all the changes. If we put together this worksheet and then we start with a net income that's not on the worksheet, then it's going to be difficult for us to get to a place of reconciling. So what we have to do, if we did start with net income, and what the net income actually was here, we would then have to record the two components. We'd have to break out net income, and we'll do that later. So what will happen is, of course, we'll take a look at this doesn't match what's on the income statement. So we'll say, okay, what's the difference? To do that, we'll go into the detail for retained earnings and say what else is happening, what's in the GL, or in our case, what's in the added material. And there's going to be, in our case, dividends. So dividends are something that's going to change retained earnings. So we'll have to break that out into its separate line items so that this change then will end up representing two line items. Again, I'm not going to do that now because I'd rather not complicate things. I'd rather just find a home for all of these first, recognizing that it will need more complication, but doing that in a systematic process after we found a home for all these first. In this presentation, we will continue putting together a statement of cash flows using the indirect method, focusing in on adjustments to reconcile net income to net cash provided by operating activities. So this is going to be the information we will be using. We have the comparative balance sheet, the income statement, added information. We took this comparative balance sheet to create our worksheet. So here is our worksheet for the two time periods. This is the difference. We're basically looking to find a home for all of these differences. We have done so with cash, and we've done so with the difference in retained earnings. So here's cash, here's net income, the difference in retained earnings. We will have to adjust net income shortly, or at the end of the problem. We'll take a look at that. We'll make an adjustment for it. We're going to now find the difference for all the rest of these. Also note that, of course, cash is going to be, the change in cash will be our bottom line number. We're going to recalculate this, but it's nice to know where we are ending up at. So this is kind of like, even though it's at the top of our worksheet, that's where we want to end up by finding a home for everything else. So now we're going to take a look at the adjustments to reconcile net income to net cash provided by operating activities. So these are going to be those types of things that we look at the income statement and we're going to say that these are non-cash activities, meaning income is calculated as revenue minus expenses, and the cash flow, if we were on a cash basis, we're looking for those things that are on the income statement which are not cash related. One of those things is always going to be depreciation. So we'll say depreciation is not cash related. Now again, when we do that, we're kind of going away from our normal setup here, which is that we're trying to find a home for all of these items, all of these differences. And if I start going back to the income statement again and pulling up information from the income statement without recognizing how it is related to a change in the balance sheet accounts, then I'm not going to be able to reconcile again. So how can we think of the depreciation in terms of a change in these balance sheet accounts? Well, it should be the change in accumulated depreciation, which started at $95,000 and went up to $110,750, the difference being $15,750. You would think that that then would be our change in depreciation that we would have to deal with here. Why? And notice the depreciation would do what you would think. We would say the 104,500, we would have to add back the depreciation. Why would we add back the depreciation? Because it's not a cash-related activity. It's included in this net income, but it brought down net income and we didn't have any cash flow. Therefore, it should be increased if we're going from net income to a cash basis. If we're starting at net income, which is too low by this non-cash related thing, then we need to add it back in. So we're going to add back in the $15,750. Now there's going to be a problem here, and that problem is that this $15,750 is not what's on the income statement, because if I check this, I'd go back to the income statement and say, the income statement is here, depreciation is $38,600. That doesn't represent the change that I'm seeing. But if I pick up this $38,600 right now, without recognizing how it fits into this change, then I'm never going to get to a point of reconciling. I'm not going to be able to figure out what the difference is. So what I'm going to do here is start with this $15,750. We're just going to put that there and say, that's where we're going to start. And I'm going to recognize that we're going to have to adjust something. What are we going to have to adjust? We're probably going to have to adjust that there was a sale of equipment or something like that. So we could do that now. What I don't want to do is put in depreciation and not reconcile the difference, not get to this $15,750. I could either leave it here now, which is what we're going to do, and come back to it later and figure out how to break that out at a later time when we do those adjustments. That's what I recommend, because that'll be easier for us to figure out all these other homes, get in balance, and then make the adjustments we need. Or we can go through it now and figure out what's the difference between what's on the income statement and here. It's probably a sale or disposal of equipment or multiple pieces of equipment. And then we'll have to break this number out between multiple components. Now to do that, it's going to be a little complex, because there might be a loan involved, there might be other things involved, which we don't have yet laid out here on our statement of cash flows. That's another reason why I would recommend first finding a home for these, the most likely home, and then recognize and say, I'm going to have to fix that, I'm going to have to break that out, rather than just putting in numbers here that are correct for depreciation, but do not represent this change over here on our worksheet, and therefore it will not end up with the change in cash. So we need to make sure that we're representing the changes here so that we end up with the right spot. So our goal now is we're going to put this change here and we're going to recognize it's wrong. And then we're going to get to the end of this and say it must have happened that we had a sale of equipment, and then we'll go back and make the adjustments in a systematic type way. Now the other thing that's going to be an adjustment here oftentimes, if we look at the income statement, is there's often going to be a gain or loss in the sale of equipment here. Now that's going to be another item that has affected net income, but that we don't want to have on the operating section. So we don't typically want to include the loss on the operating section, because the cash that we received or on the sale of equipment is typically going to be in the investing activities. So again, we know that we're going to take that loss out, but it's another one of those components that we don't have here. We don't have as a change. And so we're going to have to make that adjustment. These two are probably related. The depreciation and the loss are probably related in some disposals of equipment or some sales of equipment. And we'll have to deal with those, but it'll be easier to deal with those at the end. So what I'm going to do now is just recognize that there's a loss on the sale, probably something that I'm going to have to go back to and make an adjustment with. It's probably going to be something that will involve the depreciation we will be adjusting at the same time, and possibly some other accounts like a loan that we have to deal with at the disposal. So what we'll do now is just note that. We'll put this line item here, remind ourselves that we're going to go back. We're not going to put the amount here now because I don't know exactly how it represents these changes. I don't know exactly how it ties out to these changes. I know it has something to do with this $15,750 not matching what's on the income statement for depreciation, accumulated depreciation versus depreciation expense, but we don't know exactly what that is, and it's probably a little bit more complicated and affecting more components of the cash flow than we have laid out right now. So it would be easier for us to lay out all the components and then break out this change to its component pieces by looking at the journal entry and the activity. In this presentation, we will continue putting together the statement of cash flows using the indirect method, focusing here on the change in accounts receivable. The information will be a comparative balance sheet, the income statement, and some added information. We will be focusing in on a worksheet that was composed from the comparative balance sheet. So here is our worksheet. So our worksheet that we made from the comparative balance sheet, current period, prior period, change. So we have all of our balances here for the current period, the prior period, and the change. We have put in this change, and this is really the column that we are focusing in on. We're trying to get to this change in cash by finding a home for all other changes. Once we find a home for all other changes, we will get to this change in cash. The bottom line here, the $61,900, the major thing we're looking for is right here. We've already taken a look at the change in the retained earnings and the change in the accumulated depreciation. Now we're going to look at the changes in current assets and current liabilities. Now note here that we're not going line by line like you might think. We could go line by line and go straight down this thing and try to fill out exactly where we want to put these within the statement of cash flows. But what we're doing here is probably what most people do. We're kind of starting with the operating activities, then moving to the investing and financing. So we started with net income in the operating activities, which is really the change in retained earnings. And then we went to the activities, the decrease in or the depreciation, and pulled that out. And then we're going to move down to the changes in current assets and liabilities. So now we can kind of go through here, and we're kind of going line by line. We started with cash, it's down here. Now we're back up to accounts receivable. So it's listing what's happening here, changes in current assets and current liabilities. Now there's a couple different ways that you can think through these. You know, what are we going to do with these? The main problem is we know what the change is, but what do we do over here? What do we do in terms of increases or decreases to our cash flow statement? And that's a little bit confusing. We can memorize what to do as just to memorize what assets do and what liabilities do. And then we should probably work it out a few times to theoretically make it make sense, because that helps us to understand, you know, the accrual basis, cash flow basis, and it all. So it's a useful project to do. So first of all, we can name it something like this. We can say increase, decrease in accounts receivable in kind of like our worksheet. At the end of the day, we're going to have to say whether it's an increase or decrease. Now we can see here from our worksheet that we went from $80,750 to $77,100. That's a decrease. We see that it's a decrease. The problem is we don't know what to do with the decrease necessarily over here on the cash flow statement, because this is a decrease to accounts receivable, but we're really trying to back into what's happening with cash, what's happening to cash. And so we're not really concerned even with accounts receivable. We're concerned with the thing that accounts receivable is related to. That thing is actually revenue, sales, the income statement side, the activity side of things. So this helps us if we use this little format where we just say that increase is going to be bracketed. That means negative for this statement. Decrease is non-bracketed, meaning it's going to be positive. So if you use this little kind of cheat sheet for any kind of asset, all assets will basically work in this way, except for a contra asset like accumulated depreciation, in that anything that increases is going to be a decrease for the cash flow. Anything that decreases is going to be an increase for the cash flow. So you can also think of it kind of like the accounts receivable is reversed as than what you would think. Any asset will follow that condition. It's kind of reversed what you would think. Meaning if there's an increase, we're going to subtract it. And if there's a decrease, we're going to add it. Here, there was a decrease, so we're going to add it. Now, it's useful to think through this, and I would think through this with accounts receivable and accounts payable, and then apply the same theory to every other liability and asset type account. So if we do that, then we would say, well, what's the journal entries related to accounts receivable? When does accounts receivable go up? When does the accounts receivable go down? So accounts receivable goes up when we have a debit to accounts receivable, and typically a credit to sales when we make a sale on account, when we make a sale on credit. Accounts receivable goes down when we get paid on account, when cash goes up with a debit and we credit accounts receivable. So if we think about this, we're going to say, okay, this belongs in the operating activity because we have sales here. We're dealing with something related to the income statement, and therefore this is really what we're kind of looking for on, the income from operations. That's why it's an operating activity. In net income, however, we've included, if this were the case, this entire sales number. And if this represented all the activity, we're including this entire sales number there, whether or not we received the cash. So what we want to do, however, is just include the amount that we received the cash for under a cash basis. So if we think about this in terms of a general ledger, debits and credits, for the accounts receivable, this amount is increasing the accounts receivable, and this amount is going to be decreasing the accounts receivable. So when we look at the balance for accounts receivable, what's the change? Did the change go up or down? If we have more of these than these happening throughout the time period, then the accounts receivable is going to increase over time. So if we thought about it net, everything that happens in accounts receivable, in other words, is basically this journal entry or this journal entry. And if accounts receivable went up, meaning at the beginning balance, in this case it was 0, if it went up, say this wasn't here and it went up by 1,000, that would mean this side of the journal entries has happened more often, or at least in a bigger dollar amount. And so what does that mean for a cash flow statement? It means that we've got some sales that are in accounts receivable that we never got cash for, and we've got to reverse those out because we're on a cash basis here. We can't recognize those sales. So that's why when there's an increase in accounts receivable, we actually need to decrease it from net income to get it to a cash basis. If, on the other hand, the accounts receivable account went down, that would mean that this transaction happened more often, or in a bigger dollar amount over time, over the life of the year in this case, than this, meaning our accounts receivable would have decreased by the end if we started at 1,000 and ended at something less than 1,000. If that were the case, it would mean that this transaction happened more than this transaction. In other words, we would have received more cash on account than we made sales on account. And if you take that in net, that would basically mean that we would be receiving cash for sales for the prior year. And if we got the cash this time period, then we would need to recognize the revenue this time period. So what's going to happen is if there's a decrease in accounts receivable, we're going to increase the cash account, or the net income and the cash flow in the cash flow statement. And so note that that's going to be the case for any type of asset account that's going to follow this type of thought process. So I would think this through with the accounts receivable, and then we'll do the same with the liability in terms of accounts payable, and then apply that concept everywhere else, meaning any asset that is going down, like the accounts receivable, or any asset if it goes up, like the accounts receivable, if the accounts receivable goes up over the time period from last year to this year, then we're actually going to decrease the cash flow statement for that change, for the argument that we have here. If the accounts receivable or any asset goes down, then we're actually going to increase the cash flow statement for the argument we have here. So it's worth thinking that through with these transactions and thinking what that means. And then when you do the cash flow statement, however, you probably want to just have it memorized which way the cash flow statement will go. So when you're taking a test or you just want to put this together quickly, you're not trying to reconstruct every time what is actually happening. I would do it, however, for the two main accounts, accounts receivable and then accounts payable for liabilities, and then apply that same logic to all other assets. So here's kind of your cheat sheet type of thought process where you're just going to write down, brackets mean we're going to subtract for this cash flow statement. Bracketing, we're bracketing the increases because if accounts receivable or any asset increases, we're going to decrease it. We're going to decrease it for the statement of cash flows. If any of these asset accounts decreases in terms of what actually happened to the account, then we're going to increase it in the statement of cash flows. And we can see that here. We can see that the accounts receivable went from $80,750 down $77,100, decrease. So we're increasing the statement of cash flows. We're increasing net income. Once we understand this for this asset, we can apply the same rule, the same kind of cheat sheet type of item to every asset. And then when we think about the liabilities, it's reversed. We're going to have the increase be non-bracketed, and we're going to have the decrease be bracketed. And the liabilities are kind of more what you would think would happen, meaning if liabilities go down, then we're going to decrease the cash flow. If liabilities go up, we're going to increase the cash flows. In this presentation, we will continue putting together our statement of cash flows using the indirect method, now taking a look at the change in inventory. We're going to be using our materials here with a comparative balance sheet, the income statement, and some added information, working primarily at this time from a worksheet that was made from the comparative balance sheet. So here is our worksheet. Here's what we have so far. We basically have a comparative balance sheet in trial balance type format where we have the current year, the prior year, and then the difference. Our goal is to find a home for all of these differences. Our in number that we're looking for is basically the $61,900 change in cash. So we've gone through this from top to bottom. We're working through basically the operating cash flows from operating first, the indirect method. So we started off with the net income, then we made our adjustments. And then now we're going through basically the accounts receivable to inventory. Now, once we get into the current assets, we're all going to group those into this change in current assets under the cash flows from operations. Once we know the theme here on what's going to happen with these current assets, it's always going to be the same. But we want to remember and remind ourselves the theory of what's happening here, because this can be a little bit abstract in that we're looking for cash flows and we're taking the change, for example, in inventory here to find that. And you might think, well, how does that work? Cash flows is a timing thing. We're looking at a change in 2 points in time to balance sheet accounts. Well, and that of course means that these 2 points in time, the difference between them is going to be the activity that's happening. So we're kind of backing into this change. Now, we're not going to go through the reasoning that we did with the accounts receivable. I would recommend to think through the idea of accounts receivable and apply that same strategy to all other current assets. So my thought process I recommend doing is saying, accounts receivable, we figured out this to be the case for current assets that will be listed here in operating cash flow from operations. And that will be that the increase will be actually, if there's an increase here, that's going to be a decrease for the statement of cash flows. That's what the brackets represent. And then if there's a decrease in the actual current asset, that's going to represent an increase in the cash flows. That's what this little cheat sheet represents. Once we know that, we can just apply that to all current assets. We could say, well, it's going to be the same for inventory. So if there is a decrease, then we're going to have an increase here. If there's an increase, it's going to decrease over here. So what happened? It went from $250,700 to $240,600. And so there it went down. We have the decrease. So we're actually increasing over here. That's going to be our custom to doing so. Now, how do we know that the difference in the inventory is going to be in the statement of cash flows from operations rather than investing and financing? One, we know it's just because it's a current asset, and in this section says the changes in current assets will go here. You also could think about, well, what's the journal entry related to inventory? We could purchase inventory, where we debit inventory and credit accounts payable or cash, and we can sell the inventory, which means that we're going to have cost of goods sold, an expense account. And that, because of that expense account, because it's related to the income statement, could tell us that this is going to be dealing with the operating activities. We're really trying to back into, in a way, the cash component of the expense information that's happening here on the income statement. So that's why it's going to be an operating activity. If you think through the journal entries and say, okay, there's a major part of this that deals with an income statement account, cost of goods sold in this case, then it's probably going to be on the operating activities. Now, we won't go through the same logic we did with the accounts receivable, because I would apply the logic to accounts receivable to think through when something should go up and down. So remember, for accounts receivable, we looked at the two journal entries, one for an increase, debit accounts receivable, we credit sales. And then for the decrease, this is happening, we debit cash and credit accounts receivable. And if we think about the T account, then we're trying to think in aggregate what is happening. Why are we doing this to the cash flow statement? Well, if this happened on the accounts receivable, then you would say, well, and this is another current asset, that's why we're looking at accounts receivable, then that would mean that we had sales increasing, an account that adds into net income, increasing net income. More of this happened than this, meaning we had more sales go up for which we did not get cash. So if the total ledger for accounts receivable or current asset went up, then we'd have to say, well, that means that it increased on an accrual basis and there wasn't cash. That's why we have to decrease it on the cash flow statement. That's why we have to take it out of the net income on the cash flow. And over here, if this happened more, so if the GL happened to be the case where it went down, the accounts receivable current asset went down, then that would mean that we received cash on something that doesn't involve the income statement, something that was recorded in sales last time period. But here we want to record the sale when cash is received. We want to include it when cash is received. And that's why we have to, if the accounts receivable goes down, then we have to increase the net income on the cash flow statement. And that's going to be the same for, you could think through the same type of thing with inventory. It gets a little bit more confusing because you got the purchase of inventory in accounts payable possibly and selling it at a later time. That's why I recommend thinking it through with accounts receivable and applying this same model to the rest of the current asset accounts. When we get to the liabilities, we'll talk about accounts payable, but we could just reverse this, meaning if there's an increase in the liability, it's going to decrease. If there's an increase in the liability, it's going to increase the cash flow. And if there's a decrease in the liability, it's going to decrease the cash flow. And then we'll think through that, however, as well with the accounts payable. In this presentation, we will continue with the statement of cash flows indirect method, looking at the change in prepaid expenses. We're going to be using this information. We've got the comparative balance sheet, we've got the income statement, and some additional information. We will be working primarily with the difference in the comparative balance sheet with the use of a worksheet, taking this information to create this worksheet. So this is just basically a comparative balance sheet that has been condensed down to something that looks like a post-closing trial balance. We are constructing our cash flows from operations from it. We have all of our differences. We're basically just finding a home for these differences. We know if we do so, that if we find a home for all of these differences, then it'll add up to that difference, the difference in cash, which is basically the bottom line of our cash flow statement, or that's what we want to get to in terms of adding up the cash flows. So we've gotten so far, we're working on the cash flows from operations, and we've done the cash flows in terms of the accounts receivable, inventory. Now we're on prepaid expenses. We're just going through these. Now, if you have the cash flow and you're actually working through the cash flow, by this time it becomes kind of easy. You're saying, going, well, that's another prepaid expense. It's in the prepaid expense. It's a current asset, just like accounts receivable and inventory. It's going to follow the same principle. So I would just think of this principle as we've gotten to it with accounts receivable and apply that here. So we'll have the same concept. If you're given this in a book problem, however, we may not have this principle here. You might have a test question asking about prepaid expense. And to do that, if we don't know if it's an increase or decrease or which way it should go on the cash flow statement, it may be easier to actually think about accounts receivable and then apply that same principle. So that's how I would think about it. I would think, well, this is a current asset. If I haven't memorized that current assets, when they increase, will decrease the cash flow, and when they decrease, they'll increase the cash flow, then I can think through the logic of that related to accounts receivable, because that's probably the easiest one to think through, because it's the most clear set of two types of journal entries that go through that account and apply that same principle to all others. So I won't go through the full thing again for accounts receivable, but you can see the prior presentations to see the logic of accounts receivable and then apply that same logic here. We can see that what happened here from 2004 to 2005, 2000X4 to 2000X5, we had 17,000 in the prepaid expenses going down to 15,100. So it decreased here on the difference. We're increasing it on the cash flow statement. So again, we're just going to apply the reasoning here by saying, hey, that's what we did with accounts receivable, and we're going to show it here just with this abbreviated type of formatting. Notice in the final draft of a cash flow statement, we should say increase or decrease and not have brackets around it. But when we look at a worksheet like this, we can put these in here, and this is a less formal kind of way to say it because it covers all of our bases. No matter what happens over here, we're covered with an increase and a decrease, and it tells us whether an increase or decrease in the activity over here, what will be the effect on the cash flow statement. So it's really useful to format when you're working on something in this format. Once you've done so a few times, then you'll have this in terms of a cheat sheet. So we're going to say, well, if it increases and it's a current asset, then we're going to decrease it over here. If there's a decrease, it's non-bracketed over here, then we're going to increase it over here. The reverse will be the case when we get to liabilities. In this presentation, we will continue on with our statement of cash flows using the indirect method, looking in on the change in accounts payable. We're going to be using this information, our comparative balance sheet, income statement, and other information, focusing primarily on comparative balance sheet, creating a worksheet with it, looking like this. This basically being the comparative balance sheet, but in a post-closing trial balance format. We have our two periods and the difference between those periods here. Our goal is to find a home for all of these differences. Once we do so, we'll end up with basically the change in cash, that being our bottom line that we're looking for. We've gone through this information in terms of the cash flows from operations. We're currently looking through the current assets, and now we're moving on to the current liabilities. So we've looked at the accounts receivable, the inventory, the prepaid expenses. We have these here. We're moving on now to a liability. And notice when we do that, when we're working from the worksheet, we're kind of skipping over some things here. And there's two ways we can do this worksheet. We could go through one by one, line by line, and try to figure out where each of these lines go, whether it be cash flows from operating, investing, or financing. Or we can kind of skip, and this is what probably is done more often, and we can do the cash flows from operating first, because that's primarily where we look at. So if, that's where most of the activity is going to be on, and work from top to bottom on the cash flow statement. So when we go through these accounts, we can see, okay, cash, well, even though that's on the top of my worksheet, it's down here on the cash flow statement. That's our bottom line. And then when we go to accounts receivable, we're going to move to accounts, the current assets, and then the current liabilities. So accounts receivable is current, we worked with that. Inventory is current, we worked with that. Prepaid expenses current, we worked with that. And then equipment, not current. That's something that's not a current asset or liability. So what we do that is we could just say, okay, this specifically says current assets and liabilities, so it's not going to go here. Or we can think through it and say, well, equipment, when I buy equipment or sell equipment, typically I debit equipment and credit cash or loan. Doesn't have anything to do with the income statement, therefore not part of the cash flows from operating typically. When we sell the equipment, then we typically get cash and credit equipment. We might have a gain, but really the principal part of it isn't part of the income statement either. So equipment doesn't really belong on the statement of operations, so the cash flows from operations. It's going to go in investing activities. And then if we go down to the accumulated depreciation, same thing. We actually already did that. We dealt with that in depreciation. That difference is within depreciation. And then we've got the accounts payable, and that's a current liability, which it lists right here that we're going to look at changes in current assets and current liabilities. So we're here looking at this change in accounts payable then. Now, we already did all these current assets, and we noted this kind of terminology. We figured out what happened with accounts receivable. We noted that when there's an increase over here, it's going to decrease over here. And when there's a decrease over here, it's going to increase over here for current assets. Now we're going to liabilities, and we could say, well, it's going to be the opposite, meaning here's our terminology now. If it increases on our worksheet, it's going to decrease on our cash flow statement. It's going to reduce net income. So again, we could just figure out accounts receivable, the logic of it, and once we have that, apply that same logic to all other current assets and just reverse it. Same logic would indicate this reversal on the liabilities, it being the opposite. But then we want to think through this. It's also useful to think through it in terms of accounts payable. So I would think through these in terms of accounts receivable and accounts payable as to why we're increasing or decreasing these changes. So for example, here in the prior period, we had 102,000 in accounts payable, went down to 17,750, decrease of 84,250. That decrease is going to decrease the net income on the cash flow statement. Whereas if we were talking about a decrease in a current asset, it would increase. So let's think about that. So we're basically looking at when there's going to be an increase and when there's going to be a decrease, the two types of transactions for accounts payable. So when does accounts payable go up? Typically, let's think about an expense. We're not going to think about inventory because that's going to muddy the waters a bit. So let's just simplify this process and say that we had an expense on account. So we're going to credit the accounts payable, something we owe in the future, and we're going to credit the expense. And we know that the expense then is going to be an income statement account, and that's why we're dealing with the income statement. So this will simplify the process. If we go through inventory, of course, then we'll get to the same result, but it'll be a bit longer of a step to go through. This will be a nice, easy two-step, just as we did with the accounts receivable. So if we go to our T account, then of course, accounts payable is going up with a credit, so it's increasing with a credit. When does accounts payable go down? Well, it goes down when we pay cash and we debit the accounts payable. So these are the two things that are happening. They're happening a lot. So if we looked at the GL, there'd be a lot of activity. But what we're looking for in total is what's happening in total. And so if accounts payable goes up, that means that this is happening more than this. So in essence, this happened more often. So we can think about, like, in total, this is kind of what happened more often if accounts payable increased, meaning like the credit balance is winning. It went up in the credit direction, it increased. Well, if that's the case, then we had recorded these expenses, which decreases net income, for which cash was not yet paid. And so on a cash basis, we shouldn't have done that, right? We have to reverse that. So we have a decrease in the net income that shouldn't be there, and we need to then increase it back, put it back in there. So that is why when there's an increase in accounts payable, and we're going to apply the same logic to any liability, then we're going to increase it on the cash flow because we've got to add it back in there, because what happened is we have this expense that brought it down, which wasn't cash related, therefore we have to add it back. If, on the other hand, if we look at all the transactions in this activity and we know that accounts payable went down, then in total this transaction happened more than this one. So more happened more this one, so we can think in aggregate, basically this happened. And what happened over here? Well, we decreased cash, we paid cash, cash went out. That's going to be part of our cash flow. And the other side being accounts payable, it's not an expense. We're not recording the net income at this point in time, even though the cash flow went out. So if accounts payable went down, we've got to record this cash flow that went down. That's why when cash flow goes down, when accounts payable goes down, we are going to record a decrease in the cash flow statement. You can also think of it, of course, that we're paying cash here. When did we record the expense? Probably last year, last time period. we recorded the expense at the point in time that we incurred it. So we incurred the expense and put it into accounts payable here, and now we're taking it out. But under a cash basis, we should be recording that expense at the point in time cash was spent. And it's not happening on this transaction. That's why we're going to have to decrease the cash flow when the accounts payable goes down. So once we go through this logic, then we can apply this logic to any liability, just as we did with the accounts receivable. And even it might be easiest to think about the accounts receivable too, because revenue makes net income goes up, and it's a little bit easier to think about oftentimes to go through accounts receivable. Also, you won't be thinking about things like inventory when you think about revenue, and then just apply the reverse to any types of liabilities. But just from a theory standpoint, it's useful to think about both of them. It's useful to think through the accounts payable, what's happening here, why are we doing this, to the net income. So once you have that, once we've thought through that, then we can just write this down and have a little cheat sheet and say, well, if there's an increase in our worksheet on a liability, then we are going to increase our cash flow. If there's a decrease on our worksheet, then we're going to decrease the cash flow here. Once we have all this set up, then that's going to be our last current portion. So we're then going to sum these items up, and when we sum them up, it's common to not pick all of these up. Remember, we're going all the way back up to the top here. So we're picking up the net income, the depreciation, and then the accounts receivable, inventory, prepaid expense, accounts payable to get to this 51,650. We brought it to the inner column and then summing this up to the outer column. These don't represent debits and credits. This represents a summing of just a subtotal in the inner column of the cash flows from operations that we then break out, and we're going to call it net cash flows from operating activities. Now this one is usually cash flows from, but just note the terminology. If cash flow went down, we'd have to say used in or something like that to indicate in the words the decrease. So whenever we do these cash flows, we have to be a little bit more careful in terms of the terminology as well when we finalize this. This is basically just more of a worksheet to get the numbers worked out. Also note that we still have to make adjustments to net income, depreciation, and loss. So we're not done, but we're gonna find a home for all of these numbers, and then we're gonna go back and make those adjustments. In this presentation, we will continue on with our statement of cash flows, taking a look at the investing activities, specifically the purchase of equipment. We're going to be using the comparative balance sheet, the income statement, and additional information focusing here on the comparative balance sheet, which we use to make this worksheet. So this worksheet is our comparative balance sheet. We've been going through this worksheet and really looking for the differences. We're finding a home for all the differences. Once we do that, we're feeling pretty good. We have done this all the way through the operating activities, or the cash flows from operations. So we've gone through here and we've kind of picked and choose the items that are going to be cash flows from operations, which is probably the way most people approach this. But just note that as we've done that, we've tried to pick up the exact differences here. We haven't gone to the income statement and thought about it separately outside of this worksheet. And then we're going to go back and make adjustments. So we found a home for the difference in cash because that's kind of like our bottom line. And then we've got accounts receivable, inventory, prepaid expenses, and then we skipped equipment and went down to accounts payable to continue with the current portions here, or the current assets and current liabilities. Now we're going to jump back to the equipment, and we're going to add the equipment to where it should go, which will be the investing activities. And that's usually the first question people have when they go through this. They're going to say, well, why does the equipment go to investing activities? How do I know that? That doesn't seem intuitive to a lot of people. And one reason it doesn't seem intuitive is because, equipment, when I think of investments, I typically think of investing in stocks and bonds, not so much investing in anything else. But anything is an investment. If it's on the books as an asset, we can kind of think of it as an investment. Equipment's being long-term, we're not going to use it for a while. Therefore, it's going to be a type of investment. You can also think of the journal entries and say, well, are any of the journal entries related to income statement accounts? Because remember that the cash flows from operations is really kind of kind of like an income statement that we're making on a cash flow basis. So we're trying to conform in the indirect method. net income to cash flow from operations. So net income to kind of like net income on a cash basis. And so if we think about this, then we're trying to say, well, is there anything involved with the equipment related to the income statement? If not, then it probably doesn't belong in the cash flows from operations. And the two journal entries we typically have for equipment are when we purchase the equipment and then we sell the equipment. So when we purchase the equipment, we debit equipment and then we credit cash or loan. And there's nothing involved with income statement. Cash is a balance sheet account, equipment's a balance sheet account, the loan would be a balance sheet account. So nothing is going to be involved there on the income statement. So that wouldn't indicate that it would not be on the operations section, but somewhere else, either investing or financing. If when we sell the equipment, then we're going to debit cash and we're going to credit equipment. And we'll have to deal with accumulated depreciation as well. But yeah, none of those are going to be income statement accounts. We could have a gain or loss, however, but that's going to be minor, and we already actually dealt with that up here. That's going to be part of this transaction. So that means that the equipment is not going to be part of the operating activities. It's got to be in investing or financing. And which one do we go in there? Well, then I would ask myself, well, did we buy something? If we're buying something and it's not in operations, then we're investing in it. We're using it sometime in the future. And that's what we're doing here. So then it would be investing. The financing, of course, if we weren't buying something, if we got the money from the owners, from selling stock or from an owner investment, or we're giving money to the owners, then that would be the financing. So we're going to have an investing activity here. Now, this is another area where I'm just going to simplify this. We're going to say, okay, the equipment went from $200,000 to $262,250. So there's an increase of $62,250. And so if there's an increase, that must mean probably that we purchased equipment. If there's an increase in equipment, then we probably purchased equipment. So then that means that there's going to be a decrease in cash. If there's an increase in equipment, we assume we purchased it with cash. So if there's an increase, we're going to decrease it here. And it's the same kind of logic you can think for accounts receivable. Now, this is another area where we're going to say, well, that might not be the full number here, because when we purchase these equipment, we may have purchased it on account. I mean, we may have financed part of it. And we may have more than one purchase that happened. And the purchase can be messy, meaning we may not just have bought it with cash. We may have bought it and financed it. We may have more than one purchase. Now, luckily, the equipment account, typically, we don't buy a lot of equipment. It's not like something that's going to happen every day. It's not like when we look at the GL, the general ledger for cash, where it would just be a huge general ledger. The general ledger, the activity for equipment, should be fairly small. And so we should be able to go to each purchase of equipment and say, okay, what happened here? And try to figure out how much of it we financed and what to deal with that. And also, did we sell any equipment? If we look at our other resources up here, we'll see that cash received, we have some stuff related to equipment, I believe. Purchased equipment here. And then we have a loan. So we have some things dealing with equipment. So in practice, obviously, if it's a book problem, we'd have that information. In practice, we would probably automatically go through the equipment account and look at it and pull the documents for equipment, look at the journal entries for equipment and say, okay, what happened to it? And it's probably more complicated than one purchase of equipment for $62,250 cash. So we probably financed it, and there's probably more than one purchase. However, what I don't want to do is start breaking this number out, because it's going to get very complicated. It could fix our depreciation problem, which that didn't tie out. That's probably part of this either disposals that we had in the equipment. And there could be something dealing with loans, which is probably going to be down here in the financing area, which we don't even have yet. I don't have anything in financing yet. I haven't looked at the loans yet. So at this point in time, I don't want to start breaking those things out. And I certainly don't want to, start taking numbers that are not on this statement, on this differences. I don't want to look at numbers that aren't part of this difference and start adding them over here, like going through the GL and looking at the actual cash that was paid, put that number here without tying it out to this difference. Why? Because we'll never get to reconciling that way. We're never gonna have a process to reconcile. What we can do is say, hey, I recognize that that's probably way too simple, but I'm going to use this number now. I'm going to get to this number very easily by not breaking out these numbers into their components, but just using them, knowing that they're not totally right in all areas. Then we'll make a worksheet to fix them in a systematic way so that we can be in balance and actually have the thing work as we go through it. So note here that this is an imperfect system now that we're going to revisit as we adjust it. As we first go through the preliminary adjustments, we're just going to say equipment's the difference here. It's the difference. This happened to be an increase, so we're going to assume that we paid cash for that increase. If it was a decrease, then we would assume we sold the equipment. And we're going to recognize it in either one. It's probably more messy than that. But I don't want to deal with the mess now because I don't have all the tools like the other accounts here yet to mess with that and still reconcile to that difference. We will do so once we have reconciled to the 61,900 and go back and then fix this information. In this presentation, we will continue on with the statement of cash flows, looking at the financing activities, looking at cash borrowed on notes. We're going to be using the information with our comparative balance sheet, the income statement, and the additional information, focusing on the comparative balance sheet first that will be used to create this worksheet. We have gone through this worksheet looking for all the differences and finding a home for them, starting of course with cash down here. And then we kind of skipped around to pick up all of the cash flows from operating activities. And that's really how people usually start this thing out. And rather than going just from top to bottom, picking out the operating activities, then we went back and we picked up the cash flows from investing activities. Now we're going to go down and pick up the financing activities. And those deal with notes payable here. So we have the notes payable and we have this common stock issuance. So those are going to be things that are typically going to be in the financing. And you might think of that as, well, how would I know this? Why would I know this going through? Well, if we go through these, remember that the cash is obviously down here. That's where we started. And then the current assets versus current liabilities, most of them are going to be up here. And that's going to be the accounts receivable, the inventory, prepaid expenses, and then equipment. We had to jump down. We had to think about it. And the test I would have would normally be, I mean, you'll get used to just knowing where these things will go after time, but would be, is there a journal entry? What's the journal entry? If there's a journal entry that's related to an income statement account, a primary portion is related to an income statement account, then it probably belongs in the cash flows from operations. Most of the cash flows will be from operations because that's what we do. So this is probably going to be the largest section. That's why we spend the most time concentrating on it. If we go through the journal entries and we don't see any major income statement account, then it's probably the case that it's either investing or financing. If we purchased something, as we did with equipment, an asset, then it's going to be a form of investment because we're investing. We're not financing, we're investing. We might have financed the equipment with a loan, and that's going to be part of the transaction, but the actual purchase of equipment, the cash related to it, will go here. And then when we went through the accounts payable and then the notes payable, we start thinking, well, a notes payable, you probably just hear it and say, that probably sounds like it's not operating, it's probably financing or investing. It's going to be financing. You can also think of that through with the journal entry. What would be the normal journal entry for a note? Well, we would debit cash, probably we got cash, and we're going to credit a liability, notes payable. And there's no income statement account related to that. The other side of that is when we pay off the note, which we would credit cash and debit the note. Now, interest might be involved in there, but that's not going to be the major component of the financing of the note. So it's therefore not an operating activity. It's not kind of part of the income statement. The major portion of the note's not an income statement, so it's not an operating activity. And we're not buying anything necessarily if we just took a loan out. If we got money, cash, and credit a liability, then so therefore it's not going to be in the investing activities. Now, we might have financed the equipment, and if we do so, if we finance equipment, then no cash flow is involved, and we'll have to deal with that. But if we just borrowed cash, then it would be down here in the financing activities. So in this case, we're saying, okay, the short-term note payable went from 10,000 to 15. It went up. So that would mean that you would think that we borrowed cash. So you would think that that would be a borrowed cash. Now, again, there's not going to be a lot of loans or a lot of loan activity because it's not something we do every day. We're not going to have, it's not like going to be like the cash account where there's a ton of activity in the general ledger. We borrow loans every so often and we pay them off periodically, typically monthly or more so than monthly. So there's not going to be a lot of activity in the general ledger for the loans. But it's probably more complicated than just we took out another $5,000 loan. It might be that simple, but it might be more complicated. We might have multiple loans that were grouped together in this loan account, or we might have some more that we took out and we made payments. So it could be more complicated than this, but we don't want to go through the GL at this point in time and make that more complication. We just want to put the number here now and then break out that difference so that we can still reconcile. The same goes for this loan. This loan went from $77,500 to $100,000. So it went increase. You would think that we borrowed more money. Now again, I put here cash paid because at the end of the day, this is actually going to flip to paying cash once we make our adjustments. So I probably should have started here saying I would assume it would be a borrowing, and then if something changed it, then we'd say paid. Why would it change? Because there's some other things that's going to be happening with the detail, and with the loans and with things like equipment, that's typically going to be the case. We're going to have to dig into the GL and look at those few transactions related and see what really happened to them. The point right now, however, is that whatever cash happened with the loan is going to be a financing activity. And we want to put it in the financing activities. And before we get in there and break out all the detail, we just want to use these two numbers first so that we can reconcile. We can reconcile to this cash flows number here. Once we reconcile, once we have everything recorded, all the tools, everything on the table, then we can go back and dig through the GLs and look what actually happened on these loans and see how many loans there are, what happened with them, and break out in a systematic way, in a way that will still be in balance. And what we're really trying to do is say, here's the $22,500. We want to break that out, but still break out this difference. Whatever we break it out to should add up to $22,500, and we'll be okay. So I want to first make sure that we're in balance and then do that. And that'll be an easier process. Now, what are some things we're going to look for when that happens? We're going to go through the GL and we're going to look for any loan that happened. And we're going to say, what happened here? Is it just a line of credit? Did we just pull out another $5,000 line of credit that we're going to pay back in the future? Or is it more complex than that? Did we make payments on it? Possibly, did we purchase equipment and finance equipment? That's going to be more complex. Why? Because we didn't really pay cash. I mean, there's no cash happening there. There's no debit or credit to cash. If we bought equipment and financed it, there's no cash flow. So if that's the case, we're going to have to deal with that. And that's often the case when equipment, for example, increased up here and we have a loan happening here. So it looks like there could be a financing option that we bought equipment, didn't get the cash, and therefore it's not really a cash flow item. We're going to have to deal with that and go through that. So those are the types of things we'll take a look at when we do these adjustments. In this presentation, we will continue on with the statement of cash flows, financing activities, taking a look at cash received from issuing stock. We're going to be using this information, the comparative balance sheet, income statement, and the additional information, focusing here on the comparative balance sheet to make this worksheet. We're taking these differences in order to construct our statement of cash flows. We had the cash flows from operations, cash flows from investing activities. We're now working on the cash flows from financing activities. We found a home so far for all of these numbers, except down here we're looking at the common stock and paid in capital. So those are going to be the numbers we here are focusing on, common stock and paid in capital. Now those two, we're probably looking at them and saying, well, they're probably not an operating activity. But if we go through our thought process, we would say, what happened here? Well, common stock went from 200,000 up to 215. Paid in capital went from 0 to 30,000. So they increased. And why would that happen? Well, it must be that we issued stock. That would typically be what happened. So if this was a sole proprietorship or partnership, then this would be similar to like the investment, the owners putting money into the partnership, putting more investment into the partnership. Well, if that's the case, then if we look at the journal entry for that, we'd say, well, then we probably debited cash and we credited common stock and paid in capital. And note that there's nothing involving an income statement account, no revenue or expense, and therefore it's probably not going to be the operating activity. And then I would ask, did we purchase anything? I was like, no, we didn't purchase anything. The owners purchased the stock. The owners purchased investment in the company, but the company didn't purchase any assets. So it's not all that means it's going to be a financing activity. So it's not investing, it's going to be financing. The company got money from the owner. The owner is financing the company, it's giving capital to the company. So it's going to be a financing activity that we're going to have here. And we'll of course say that cash received from issuing stock is going to be the 45. Now the only confusing thing here is that of course we're going to group, this is the one case where we're not finding a separate home for these two. Why is that? Because remember that when we issue the common stock, we usually issue it at par value. And then, so we debit cash for whatever we get. And then we credit common stock for the par value to make it all even. And then we credit paid in capital. So these two accounts are really kind of intimately linked. And therefore the 30,000 and the 40,000 kind of go together. And so we're going to increase this by the 45,000. So we'll put them together. And we would think that we would be pretty good there, that full 45,000 is probably due to the issuance of stock. Now again, we don't issue stock all the time. If you think about the stock exchange where they're trading stock all the time, that's because it's not an initial offering. Those aren't offerings from the company typically. They're just buying and selling from other people, other investors. The money, the investments to the company from the owners, the issuance of stock, hopefully it doesn't happen all that much, because that would mean that the owners keep on having to finance the company. So it's going to be another area where there will be few transactions. If we want to check that number and see if there's anything else that happened there, we can go into the common stock general ledger account and just see what's the activity and just see exactly what's happening. In other words, there's not going to be a whole lot of detail as there would, say, in the cash account for the GL, in the common stock and paid in capital. So we can go in there and say, okay, what is this difference from? And there shouldn't be too much going on for us to figure that out. And most likely, of course, it would be a sale that happened. Once we have this information, we can sum this up. So the 5,000 to 22,500, the 45,000 adds up to the 72,500. So what we have now is the cash flows from operating activities that we brought out to the outer column here, summing up all of this, bringing it to the outer column, cash flows from operating, cash flows from investing, only having this one item here. So we bring that out to the outside. And there'll be more items when we do the adjustments. But then we have the cash flows from financing activities, including these items, bring it out to the outside. And then if we are to add these up, then we're going to say the operating activities, 51650 minus the 62250 plus the 725 is going to be the 619. So that adds up to that 619. Remember, that's the one we kind of left alone. We put it down here to see where we're going, and now we're kind of verifying, okay, that looks right. And then what we really want to do is get back to this number, because this is kind of our end goal here, but it only ties out to our worksheet. And we want to make it really easy for the readers of the financial statements not to tie out. We don't want to make them do math to figure out the difference between these two periods as they could with the balance sheet. We want to basically make it easy for them and do the math for them. So we're just going to say, okay, here's the cash at the beginning of the year, which is the 61.5. So this plus this gives us to the cash at the end of the year, hit this number here. So this is really kind of the number we're looking for. That's the change. And then we're going to say, okay, let's get back to this number, because that'll be really easy for them to tie out to the balance sheet number, which will be that number here. So this is going to be the full process. Now note, now we have something that's in balance from doing this. We can say, okay, this whole thing works. However, it's not right, because the income statement, as anybody will tell you if they watch you put this together, the first thing they'll say is that number's wrong because it doesn't tie out to net income on the income statement. And we know that this number is going to need some adjustments and whatnot. But what we do have is something that works. It's in balance. Whereas we would not have that if we just start pulling numbers from the income statement that don't tie into our worksheet at all. So what we want to do now is go, okay, now we've got something that works. Let's fix these systematically one by one. in such a way that we remain in balance after each step, kind of like we would if we were doing journal entries. So we'll use the same kind of journal entry, double entry accounting type of thought process to do adjustments here that will hopefully leave us in a position where we remain to be where we know we're correct. In this presentation, we will continue on with our statement of cash flows. We're now going to enter the final adjustments that we will need to finalize the statement of cash flows to bring those last few numbers to the correct balances. In order to do that, we're going to use this information. We've got our comparative balance sheet, our income statement, and additional information. We put together most of our information so far with the comparative balance sheet, which we made into a worksheet. Now we're going to use some of these other resources, the income statement, the additional resources, to make those final adjustments, those fine tunings that are needed to get those few numbers that we have left and noted into balance. And this is going to be part of the normal practice where once we get this information set up, we can then make some comparisons, such as net income, does it tie out? Such as depreciation, does it tie out on the cash flow statement to what we see here on the income statement? Then we can have this other information which will be given in book problems. In practice, of course, we'll just go to the general ledger and we'll get this information. In a book problem, we don't want to give all the detail of a general ledger or just when we're going over an example. So we have to just kind of give this other information. In practice, we go through the GL and we can see that information. Then we'll pull any documents we need, including if we purchased the equipment and we took a loan out or any of that kind of stuff. We'll purchase that, we'll pull that out. We'll talk a little bit about that process as we go through here. So now what we want to do is look through these journal entries related to this additional information. And if we think about what we've had so far, we noted that there's going to be a couple areas we need to go back to and fix. One, we noted that net income didn't tie out to the income statement. We noted that depreciation didn't tie out. And we noted that the equipment that we put on the books, probably something more happened. That's always something we need to go back to. And we noted that the notes payable is probably something more to it than just taking the difference between notes payable. It could be more activity. In practice, we would look at the GL again. Here, they're just going to give us that more activity. And we're going to try to figure out, okay, what types of journal entries is this added activity given related to? Now, obviously, if they're giving this information in like a book type problem, then it's useful just to go through that and think about it. Okay, what is the journal entry related to these? In practice, we would always pretty much do this for a cash flow statement for the equipment account and the loan account. If there's any activity, we would naturally go through there, figure out the few transactions related to it and what the journal entries would be. And note that these types of accounts don't have a lot of activity, so it shouldn't be too difficult to do that. Meaning, we're not going to buy equipment every day. It's not like inventory. So whatever activity is there, there should be fairly few of it, and we can figure out what happened and make these types of adjustments as needed. We're going to start here with E because that's actually going to be a smaller journal entry. So that's where we will start. We'll pick off that one first, then move from there. It says we declared and paid cash dividends of $53,600. So anytime we get this added information, I would think about the journal entries related to them, and then we'll go back to our worksheet and say, okay, what are we going to do with our cash flow statement based on this information? So if we declared and paid cash dividends, we could think of that as two journal entries where we declare the dividend, have a payable, and then we pay it. But if we combine those two out, if they both happened in the same time period, then in essence we had retained earnings and cash. In other words, cash went down, we paid cash. The debit's going to go to retained earnings, bringing down retained earnings. So, and this is similar to like if a withdrawal for a partnership or a sole proprietor. So we gave money from the company to the owners in the form of dividends, cash went down, and we debited the equity account, in this case retained earnings, for a corporation. So what does that do? If we think about that journal entry, what are we going to do to our cash flow statement? Well, on the cash flow statement, we can think, well, net income is going to be affected here on because of this retained earnings. Why? Because remember when we made this net income, what is it from? It's from the difference in our worksheet between the retained earnings. So we made the assumption, we said, okay, we didn't pull this from the income statement. We said, what would it be represented as on the difference between the balance sheet accounts? And typically it would be the difference in retained earnings because we closed out the retained earnings or the net income to retained earnings. So the major difference between retained earnings between two accounting periods should be net income. And that's what we used here. We noted that it wasn't the amount that's on the income statement and said, hey, we're going to go back and fix that. Now we're going to go fix that. We're going to say, okay, net income is one of those areas that this hopefully will bring us now in balance with the income statement. But there's got to be something else happening here because we're already where we want to be. So we got to do something equal and opposite, kind of like a journal entry, somewhere else. So note, I set this up kind of like a journal entry where we're increasing and decreasing. If we do something to net income here to make it correct, then the other side we can put here to cash paid for dividends. So that's going to be down here in the financing. So we paid cash for dividends. That's what happened here. So we're going to make net income correct, basically, and then we're going to post the difference here to cash paid for dividends. Note that if we didn't do it this way, so let's see what that happens. If we do that, then we're going to say, okay, here's net income, went from 104,500. I'm kind of putting this like as if it's an adjusting worksheet for adjustments in terms of adjusting entries. And here's our ending adjusted cash flow. The other side of it's going to go down here, and that of course should keep us in balance. So we're not talking about debits and credits, but we're using kind of a similar system. We're saying, hey, we tied out to the 61,900 already using the numbers that we get from our worksheet. If we make any adjustments, we want to do it systematically. We want to say, okay, if we're going to adjust net income to what is on the income statement, hopefully, then we also want to adjust something else so that that difference that we got from the difference in retained earnings is still there. If we did not do it this way, in other words, if we took this number, which is the amount on the income statement, it's working, here's the income statement, here's this number, that's the number we wanted. If we started out just pulling this number and saying that's going to be our first number that we work with, and our first number that we're working with is not on our worksheet that we're using, then it's very likely that we wouldn't understand what the differences are, be able to figure out why we're not in balance. If we use this number, which is not net income, but then go through this whole process, then we can now figure it out in a systematic way. And note also that we have to do this whole thing basically to have the space down here, to have it built out to be able to break this number out between the two. So now we can go down here and say, okay, the other side of it's going to go to cash paid for dividends, and it's going to be a financing activity. And that'll put us back in balance. So cash went out because we paid it for dividends. It's financing because we're dealing with the owner. It's not a income statement activity, so it's not in the operating activities. We didn't buy anything for the company, so it's not in the investing activities. We're dealing with financing the company and paying back the owner. Therefore, it's in financing. So that's going to be our first adjustment that we'll have. And that, of course, makes net income tie out. So that worked. So that looks good. Now we're going to do our next adjustment, and we're going to say that we're going to have the sold equipment. We sold the equipment, and it says we received $26,050. So if we think about the journal entry first, and then kind of think about what we're going to do in terms of increases and decreases to our cash statement, we can say, okay, the cash went up, equipment must have gone down, and then the accumulated depreciation is going to be a debit, because remember, it's on the books as a credit. We have to debit it to make it go away. The difference then is going to be $2,100, and that's going to be a loss. So that's what we need to be in balance. That's the plug. So if we took this plus this minus this, we'd need $2,100 in order to remain in balance. So we know that this is going to be a loss. We can think of it a couple different ways. One, it's a debit, and that's kind of like an expense. Expenses are debit balance accounts. Therefore, it's probably a loss, not a gain. And two, if we looked at the book value, which would be the $51,000 minus the $22,850, that would be greater than the cash we got, and therefore it's a loss. So that's why we're going to name it a loss here. And then that's not the only thing that happened to equipment, though. So notice the equipment, of course, is more messy than we would just assume, like we just got cash and sold the equipment. So the other side of this is that we bought equipment. And how would we know this, you might be asking? We would look at the GL, we'd look at the two accounts that made the difference up in the general ledger, then we would find the journal entries related to it and the documents possibly for those purchases. So then the equipment, it went up by $113,250. Cash, we paid $43,250 and we financed it $70,000. So that's common because we buy an equipment and we didn't have the cash for it. It's common to finance the equipment. So we have this debt now. So these two then are going. This is where the most complicated component is of these journal entries, of these types of cash flow statements generally, to figure out the equipment, because notice all these accounts it's affecting. Now, if you do everything up to this point the way we've looked at it, even if you can't figure out this last step, if it's a book problem, you will have picked up a lot of points. If it's a problem in practice, you'll be able to go to your supervisor or whoever and say, look, I know exactly what the difference is. I know exactly what's going on. I know exactly how this thing ties out, and it has to do with equipment. And you can start from there and not have to start the whole thing over again. That's the point of this process. Now, our goal now is to take these journal entries and look at our cash flow and try to say, okay, how are we going to apply these in terms of an increase and decrease, convert this into kind of like an increase, decrease to our cash flow accounts so that we're still in balance. So we're going to use the same kind of balancing concept to adjust these out so that we're still in balance here. So whatever we do with these journal entries, we got to find a home for them in kind of like an increase and decrease mode so that we're still in balance. That's going to be our goal. Now this, again, a little bit difficult, a little bit more difficult to do this. Now we noted that we saw when we built this cash flow that depreciation was not right because it didn't match what was on the income statement. We note that we saw a loss on the income statement, and we didn't put the number here, so there's probably something there. And we noted that cash paid for equipment was probably too simplistic when we put that on there. And we noted that the cash paid for the long-term note, again, probably too simplistic. So we noted that all these things could have more detail to it. However, because they're all tied together with each other, the equipment, the loan, it would have been very difficult for us to do that as we construct. So it's better for us to put these numbers there and now go back to it and say, okay, here's the puzzle. We've got these journal entries, and we have to fix these accounts. Now, there's a couple things we know. We know what the loss is because it's on the income statement, and we know what the depreciation is because it's on the income statement. And now we know these journal entries. So let's take this information and try to see how we can adjust these accounts. So first, the depreciation. We're going to say we adjusted depreciation, and that's going to be basically this number we're picking up. And we can verify that by saying, okay, if we adjust the depreciation, if we increase the depreciation by $15,750, will that come out to the depreciation on the income statement? And we'll see that it will. We'll have to check that. And then we're going to say that the cash received from equipment, we're going to basically say that that's coming from this account. Now, that might not be as intuitive. We're going to say, well, why is that? Well, this is debiting cash, and that's our cash flow statement over here, and we just need to note, where did that cash come from? We're looking at cash flow here. Well, that cash flow came from equipment that we sold. So, and then we're going to ask ourselves, well, is that operating, investing, or financing? It's not going to be operating because it's not really an income statement account. This account's income statement, but the bulk of this isn't really an income statement transaction. Really, it has to do with us buying or selling an asset, which is an investing activity. So we're going to be dealing with cash received. We're going to say it's an investing activity. We sold property, plant, and equipment. Anytime we deal with property, plant, and equipment, it's typically going to be dealing investing activity when we're working with a cash flow statement. And then we got cash paid for the purchase of equipment. That's going to be the 51 here. So the 51, and so why would that be? Well, cash paid for the purchase is where we put the entire thing, the entire difference between, that's really a result of kind of these two journal entries. So we're breaking this out in a sense to its components now. So that's why this has got to be a component, and it's got to go down. And then we've got the loss. And the loss is something we can see here. We knew it was on the income statement. So we're going to pick up that loss and put it here. So of these, you can probably figure these out. And then you got to go, okay, this is where the difference is going to go to, because that's where we put everything to. So that's the other side of it. And then we've got this journal entry. Now the major thing with this journal entry is that we've got this loan, this financing amount here. So the financing amount is going to be the issue because the financing amount is not cash related. So we're going to be dealing with the $70,000. So we're going to say that cash paid for long-term note here is going to have to be adjusted because that's going to be the note payable. The other side of it's going to go to cash paid for the purchase of equipment, which is where we put everything. That's the other side of this transaction. So you might want to spend some time with something like these journal entries and try to figure out why that mull it over a few times. If we were to post this out then, in terms of this kind of increase and decrease, not really a journal entry, but a similar kind of concept, to our worksheet, we're going to say, okay, here's where we were at before. We're in balance. This matches what's on our balance sheet. We need to do increases and decreases here in such a way that we don't affect the bottom line. So they have to equal in some way. So if we do our adjustments that we had, we're going to say depreciation. We'll record that, gets us to 38. So it was at 15,750 plus 22,850 brings us to 38,600. The loss, we didn't have one before. It's going to go up by 2,100 to 2,100. We had the cash paid for equipment was at 62,250. There were two transactions. So this is the net of those two transactions, bringing us to 43,250. And then we had the cash received from the sale of equipment, 2650, bringing us to 2650. And then we have the cash paid for long-term debt. That kind of flipped this one. This, we would have thought it was a receivable, and now it flipped it, 70,000 paid. So now it's really paid, right? 47,500. So this is going to be the activity we have. Now, if we look at all that, then here's our adjustments we just had. They add up to zero. The additions and the subtractions add up to zero. So we end up in the same spot is the point. So we got to this amount by doing a simplified method, just looking for the differences in our balance sheet accounts so that we know we tied out. Then we went back and looked at those problem cases and figured out our ending numbers, made these adjustments in such a way that they're going to be in balance so that we're still in balance here. And now we can tie out these numbers. We can say, does net income work? Does depreciation work? Well, if we go here, net income, 158,100. Depreciation, 38,600 should be on the income statement. So it looks like those are going to be good. And of course, when we go to the loans, we want to be able to say, does that tie out to actual loan documents that we got when we look at the GL? It's the amount we borrowed in a short-term loan. In this case, cash paid on long-term notes. Does that add up to the cash we paid when we financed the equipment, or the cash we actually paid on the notes? And then cash received from issuing stock, 45, and the dividends. We can see that we have some of the additional information. We checked these amounts on here on the income statement. Then we have, it says that we borrowed short-term loan, 5,000. That looks good. Paid to reduce the long-term loan, 47,500. And that now, 47,500 is where we're at there. So that's going to be another one of our major kind of check figures to look through that. So it looks like everything ties out. Now we're going to take this and we're just basically going to eliminate the adjustments and be left with just this. So we're just going to say, okay, now we can hide this information and be left with our ending numbers, which would look like something like this. So again, this is more of a kind of a worksheet because we could go through here and fix up and trim up the terminology and whatnot. But that's a kind of a worksheet process that can get us through this process in such a way that we can do it in a step-by-step basis. And the cash flow statement is similar to like a balance sheet where when we get to the end of it, oftentimes it's not in balance and no one knows how to fix it except to start all over again. Well, this process will hopefully give us a process that we can not have to start all over again and have some check figures along the way. In this presentation, we will take a look at the statement of cash flows using the direct method. Here's going to be our information. We got the comparative balance sheet, the income statement, and some additional information. We will use this information to put together our worksheet, which will be the primary source used to create the statement of cash flows using the direct method. This is going to be our worksheet. Now, most of this worksheet will be similar to what we have done for the indirect method in that we took the difference in the balance sheet account. So we're taking the current year and the prior year, the current period, the prior period, all the balance sheet accounts. So we've got cash down to the retained earnings for the balance sheet accounts. But we're also, in this case, going to give us the income statement accounts for the current period. So in other words, we're going to break out the retained earnings, the amount to its component parts, meaning we've got net income being broken out on the income statement. We've got sales, cost of goods sold, the income statement accounts. So it's going to be our same kind of worksheet here. We're going to be in balance. We've converted it from a plus and minus format. We removed all of the subtitles as we did under the indirect method, and we converted it from a plus and minus format, as it is here on the financials, to a debit and credit format, verified that we are in balance, in a trial balance. And remember, to do that, we got to make sure that we're breaking out the retained earnings to its component parts, to the income statement. So this is the kind of the tricky thing to get this worksheet in place, meaning you took the balance sheet and we're saying we're reconstructing the trial balance now, kind of going in reverse. And that means that the retained earnings really is now the beginning retained earnings, and all the activity, dividends, net income, sales, and expenses are not yet closed out to it. So you'll note that in comparing that to 2000, the prior period, we're not going to show the income statement because I don't need the income statement for the prior period because it was closed out to retained earnings. So we're going to say that is closed out to retained earnings. We're going to show all the activity that happened in this time period, the current period, in terms of the revenue accounts not being closed out. Why are we doing that? Why are we having this difference? Because when we look at the first component of the direct method, which is going to be the operations, cash flow from operations, we're in essence going to reconstruct the income statement because that's basically getting to net income. We're basically going to get to this net income number, not using an accrual basis, but using more of a cash flow basis. So that's what we're going to try to do. So in order to do that, I want to list out this information, that detail. And what we're going to do is go through these income statement accounts, sales, and convert it and say, well, it's not sales anymore. It's going to be cash received from customers. And we'll go through these accounts and we'll basically kind of convert them from an accrual basis to a cash basis. That's going to be our goal. Now note that the only difference between the direct and indirect method is in the cash flows from operations. So the indirect method takes net income and kind of backs into the cash flow on a cash flow basis from operations. Whereas the direct method is going to try to convert each line item, in essence, to its cash flow basis. So this is it's more direct because it makes more sense. If you look at it, you're going to say, I'm basically reconstructing here an income statement on a cash basis rather than an accrual basis. So to do that, what we're going to do is we're going to say, okay, cash received from customers. That's going to be kind of like our sales item here. To pick up the cash received from customers, you're going to say, well, yeah, we're going to pick up that sales item, but that's not the only thing we're going to pick up. Why? Because that sales item is on an accrual basis. How do we convert it to a cash basis? Well, if you think through it, you're going to say, well, what does sales happen? What happens in sales? There's two journal entries that would happen. The process of recording sales typically has that the sales cycle would be that we would debit the accounts receivable and credit sales. That's the increase in this number. And then we would get the cash later on, which means we would debit cash and credit accounts receivable. Now, anything that is still in receivable here is then not on a cash basis, meaning in this case, the receivables went from $80,750 down to $77,100. That would mean that we got more cash than we made sales in aggregate. So that would mean that we would have to adjust this account, the sales account, for that. So we're going to take this 1,185, add the 3,650, because we must have gotten paid here. We got paid over and above the sales we made in 2000X5. So we're going to have to basically net those two out, and that's going to be making then the cash received. So we've converted the sales to cash received by looking at the other account that's an accrual account related to sales. Then we're going to do cash paid for merchandise. We're going to do a similar process here and say, okay, well, what's going to be involved with the cash paid for merchandise? Well, that's going to mean that we're going to have, of course, cost of goods sold, but we also have the inventory. It's going to be part of that process, and we've got the accounts payable. So this is going to be more of a kind of a confusing process. We're going to have to put these together in order to see what the cash paid for merchandise is going to be. And again, you can think through this by thinking of the journal entries. What's the cycle for merchandise? Well, typically we would purchase the inventory, debiting inventory, crediting accounts payable. And then we would pay for the merchandise. We would credit cash and debit accounts payable. And then at some point we would sell the merchandise, which means we would debit cost of goods sold. And that would be part of the sales process when we sell the merchandise. So these three accounts are going to be combined together to give us this $669,150. So we've got a deal when we have the cash paid for merchandise. You can see this gets to be a little bit confusing because this cost of goods sold represents an accrual basis at the point of when the sale happened. Of course, when we paid for the cash, when we paid for the inventory, it's going to be a different scenario because the cash basis will differ from the accrual basis. So then we're going to have cash paid for other operating expenses. So if we pick up those accounts, we're going to have the other expenses here. And then we're going to have to say, okay, is there anything that's non-cash basis for these other expenses, whatever these expenses are? Is there anything up here that's going to be an accrual type of account? And if we have something like prepaid expenses, then that's going to be an accrual type of account related to the other expenses. So any other expenses, then we're trying to see, are they all cash expenses? Did we pay cash for them? Or is there some type of accrual related to them? If we've got prepaid expenses here, then we're going to have to net those two together in order to get, in this case, decreasing it by the $360,950. So those two will be making up the cash paid to convert this number to an accrual basis. And note what we're doing here, of course, is finding a home for all these differences, just like we did with the indirect method, where at the end of the day, we're going to get down to this 61,900, but we're finding a home for all of these differences. And we're just going to kind of color code them as we go through this. Okay, so then we got cash paid for taxes, and that's just going to be this item here. There's no accrual basis up here. We don't have any prepaid taxes or accrued taxes, so we're just going to pull that over directly, and that'll give us our total. So if we add up these, add and subtract these up, we get to $130,200. Next, we're going to have the cash paid for equipment, and that's going to be in the cash flows from investing activities. So we finished the net cash flows from operating activities. Now we're going to go to the investing activities. Now, the equipment is often the most messy item here, because if we look at everything that's related to equipment on our statement here, on our differences, we're going to say, well, obviously equipment's going to be related there. And note that accumulated depreciation, we could say, well, the difference in accumulated depreciation is usually going to be the depreciation expense here. And if we were talking about the indirect method, we would be taking depreciation expense in the cash flows from operations because we would be starting at net income and we would be pulling out the depreciation. Here, of course, the depreciation is not represented because we're reconstructing it and therefore not including depreciation in our construction. So in order to add these numbers together, in order to get them somewhere, we're going to combine them together in this cash paid for equipment account, and then we're going to go through any adjustments we need to make in order to break it out. So we're going to say, okay, I need to find a home for this one, equipment. I need to find a home for this difference in accumulated depreciation, which you would think would match out to the depreciation expense. It doesn't. That means that there's probably a sale that happened. So I'm just going to match those out now in this one number. And then I'm also going to include the loss, which once again, if it was an indirect method, we would be pulling out of the net income number. But because it's a direct method, we're just never going to include it in that number. So again, I'm just going to combine that into this one number for now so that we can find a home for it. And then we're going to go back when we make our adjustments and try to say, okay, what happened with equipment? Did we buy equipment? Did we finance equipment? How much equipment did we buy? Did we sell equipment? And we'll have to go through that whole process. So now, for now, we're going to adjust. We're just going to combine these numbers together, put them in there as cash paid for equipment, and note that we'll probably have to go back and look at that again. Now, most of the rest of this stuff is going to be similar to what we did on the indirect method. So remember, the main difference is going to be the cash flows from operations. And then the equipment, of course, is that kind of messy account because we have the income statement accounts. We have some differences there on the equipment. When we look at the rest of these numbers, we're basically pulling over these numbers in a similar fashion as we did in the indirect method. So I'll leave those accounts there. Bottom line is we're trying to get to the ending cash, an ending cash that ties out. We're trying to get to the cash here, the change, 61,009 that matches here just like we did with the indirect method, and the ending cash 123,400 that matches here. Finding a home for all of these numbers will do that. We don't really want to get into breaking out these numbers or pulling information or numbers from anywhere other than this worksheet until we match this worksheet out and then think about what kind of adjustments we can do to trim this down, fix any problems that are there. Now, if we look at the added data, again, we're going to look at those journal entries related to the equipment. So we had the sale of equipment, $26,050, the equipment cost, $51, the depreciation, $22,500. This is the journal entry that would be related to it. And again, in real life, we would look at the GL, we'd find this transaction, and then possibly pull out the paperwork related to it if we needed to. And then here's the loss. So again, this is like a plug. So if we took, the debits minus the credits, we would need a plug of 2,100. It's a loss because it's a debit. Also a loss because the cash received is less than the book value of 51 minus the 22,850. Then we had this other one, equipment that we purchased. Sticker price 113,250. We only paid 43,250 for it. So then we had this note payable, this financing we dealt with. So this all deals with that equipment account. What are we going to do now to fix our equipment account? Well, if we go back here, note we had this red item, we're going to say, okay, we're going to do something to that. Now we need to go through this and say, how are we going to use these journal entries to fix this number to make it, align with what we think it should be, and yet not throw us out of balance. That's our goal. That's why we did it in this process. When we look at this, it's a little confusing because we can't really go line by line. We're going to try to look at this and say, okay, what do we need to do to make this work? We know that the cash paid for equipment, we're going to have to adjust that. Why? Because that represents the actual cash flow here. So the cash paid for equipment, we're saying was this 43,250. So what we're doing here is saying, well, this number here needs to be that 43,250. So we're taking what's there, it's the 87,200 minus the 43,250, and that should give us what it needs to be adjusted by, because that's what this cash payment is made for. And then we got a cash received for equipment, and we know that we kind of included that here, and we know that should be broken out because that's cash that's coming in. So we need another line item. And we know that's the case. So we're going to put that here. That should make these two amounts correct. And then the difference then is going to be going to cash paid for the long-term note, because that's where the other side of this happens. So the other side is going to be this notes payable. So the notes payable then is going to be the long-term note, which we had here, that should flip to be the correct amount. So it was at 22,500. And this actually looks like the cash, like as if we received cash. So it needs to be flipped in the negative direction. And then once we do that, we can kind of tie that out to the actual note in terms of the cash paid for the long-term note. We can look at the cash that was paid on the note, which is going to be given in our example. So this is the type of transaction we'll have in terms of increases and decreases, which should keep us in balance here, should make this right, and hopefully this right as well. So let's see if we do that. Then if we do that to our worksheet, we're going to say that the cash paid for equipment was at 87,200. The 43,950 brings it to 43,250. Then we're going to say that the cash received from the sale of equipment was 26,50 to 26,050. And then the cash paid for long-term note was at 22,500. Looked like a receiving. We took it down 70, reversing it down to 47. So now this description is accurate. Now it's cash paid, not received as it looked here. So then if we look at the full worksheet, then we could say, okay, this is where we were at before. This number was right, this number was right, which was the summing up of these numbers. We had to fix this number and this number and this number. We did so by having additions and subtractions that are in balance. So kind of like a journal entry, which left us with this hopefully being correct, 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 and still ending up in the same spot. So we're still good. We should still be in balance. So then these numbers then are going to be like our final balance. So we can kind of eliminate this stuff and then be left with our final balance, which would look something like this. Again, this could be cleaned up further in terms of formatting and some terminology and whatnot, but this is going to be a worksheet, a step-by-step process to help us to get to a place where we're in balance and we can, if anything goes wrong, we don't have to go back to the beginning and kind of set this thing up in a step-by-step process. In this presentation, we will take a look at the statement of cash flows, non-cash items. First question, why would we be looking at non-cash items when considering a statement of cash flows? We're going to go through a list of non-cash items first and see if you can recognize a trend in these and why we might be linking them to a statement of cash flows discussion. Then we will explain more fully the idea of looking at non-cash items when considering a statement of cash flows. So some examples of non-cash items would be the purchase of long-term assets by issuing a note, the purchase of non-cash assets by issuing equity or debt, the retirement of debt by issuing equity stock, lease of assets in a capital lease transaction, and exchange non-cash asset for other non-cash asset. Consider these examples and note some of the common features, including that they deal with investing and financing activities, and think through why we might be linking them to a statement of cash flows. We'll go more fully through this by giving an example of the purchase of long-term assets by issuing a note, an example that we can then apply out to the rest of these items. So what are we going to do with these non-cash items? We're going to report them at the bottom of the statement of cash flows or report them in a note related to the statement of cash flows. So we're going to have to say in some format or other, hey look, these are some non-cash items that we're linking to, for some reason, the statement of cash flows. So they're going to be important things that we want to disclose to the reader of the financial statements, either in connection directly to the statement of cash flows or to a note to the financial statements that will be in reference to the statement of cash flows. So that goes back to the question again as to why these non-cash things would be linked to the statement of cash flows. Why don't we just put them in a different note? Why are they somehow tied to the statement of cash flows? And to give an example of why that kind of makes sense, let's take a look at one of these items that would be a non-cash item that we would need to report. We're going to purchase long-term asset by issuing a note. Let's think about the journal entry related to that. We're going to say that the equipment would go up. We would debit the equipment if we did this, and then we would credit the note payable. So no cash is taking place here. There's no cash happening, so it would not be a cash item. We wouldn't be reporting it on the investing activities or the operating activities or the financing activities. But we can also think of this as kind of two things that really happen. We kind of cut out the middleman. We kind of cut out cash as the middle transaction here. You can consider this as two transactions that could have taken place and the same end of the same result, which would be that we had cash. If we got cash goes up because we took out a loan, so we could take out a loan and then pay for the equipment, and we would end up in the same place. So if we took out a loan, we would increase the liability as we did here. We would debit cash, but then we would just turn around and take that cash and pay for the equipment with it. So then we would debit equipment and pay cash. So note what we did here is this transaction that would deal with cash as the medium of exchange for this transaction, we just kind of cut out the middle person. We cut out the cash and went directly to this transaction here. So you can see if this is why they're related in some format to the cash flow statement. We're basically saying it's a transaction that would have had cash as an exchange, but the cash was removed and we did some type of other exchange. These transactions will typically be including financing and investing type activities, meaning they're going to be dealing with notes payable, bonds payable, purchase of things like equipment, and no cash will be exchanged, but because of this relationship, we still want to disclose them in relation to a cash flow statement. So now that we can see this transaction, let's see if we can apply that to some of the other examples we have. So we've got cash purchase for long-term asset by issuing the note. Again, you can kind of break that journal entry that you would think of when you issue a note. If we bought something and you'd issue the note into two journal entries dealing with cash, receiving cash and then paying cash. Another example would be the purchase of non-cash assets by issuing equity or debt. So if we bought some type of non-cash asset, didn't pay cash, but we issued equity or debt, you can think of that same type of transaction. If we broke that up into two transactions. We got the debt, got the cash, and then paid for the non-cash item. So if you can think about being able to break these things up into two transactions of getting a loan or getting equity, issuing stock, getting money, and then buying the non-cash purchase for cash, then that's probably an item that we would need to report here. If we have a retirement of debt by issuing equity stock, you can think of that as the same kind of thing that's going on here. We could have had the issuing of stock, gotten cash, used that cash to retire the debt. Instead, we just retired the debt with the stock. We have the example of a lease asset in a capital lease transaction. That's basically the same thing as a purchase on financing a capital lease. A capital lease is structured as a lease, but really it's a purchase that we financed in form, substance over form, or in substance. In substance, it's really a purchase that was made, and then we financed that purchase. So that's going to be a similar example as we have up here with the purchase of long-term assets by issuing a note. And then we have the exchange of non-cash assets for another non-cash asset. And again, that would just be an exchange that would happen. We gave one asset and received another. You can again think of that as, well, what if we, gave the asset, got cash, they gave the asset, got cash, and then, we exchanged for cash. So anything that you can kind of break out, and you can think, well, basically we eliminated the sale and then the cash transaction. That's going to be one of those types of issues that may be needed to be reported as non-cash items related to the statement of cash flows. Hello, in this lecture we're going to talk about creating a statement of cash flows using the indirect method. We will be able to define a statement of cash flows, create a statement of cash flows, explain a process of creating a statement of cash flows designed to limit mistakes, and define the indirect method. So what we'll do is we'll work through basically a problem and look through the statement of cash flows. We want to think about a few things. We want to think about how to create a statement of cash flows. We want to think about a few definitions of what is a statement of cash flows. We want to kind of explain what the purpose is of a statement of cash flows, and going through the process can help us to do that. Also want to point out that creating a statement of cash flows can help us with setting up a problem in such a way that we can limit the amount of mistakes that we will make. So a statement of cash flows is something that in a lot of firms, people generally often have problems to create the statement of cash flows, and it's good practice to go in there and create the statement of cash flows and try to create a system in which it's easy for us to have checkpoints and see where a problem is going to happen. So that's also something that we will work through with a statement of cash flows, because at the end of the process, just like if we were creating a balance sheet, it's easy for us to get to the end and it's not in balance, it's not working, and not have any checkpoints to go back and try to figure out, well, where is it off? Why is it off? And then you start the entire thing over. So creating a process in which you can have checkpoints and go back and try to figure out where it went off is good, not just for accounting, but for any type of process. If you're trying to figure something out, you want to see, okay, where can we find points in which we know that we're correct here. We know we're correct there. Then we can move forward in a systematic way. Also want to point out that a statement of cash flows is really good for learning accrual concepts. So you can get a lot of the statement of cash flow questions right if you just memorize the types of areas within the statement of cash flows. But if you're actually going to work a long problem like this, or work a statement of cash flows and create one from scratch, if you can do that, explain that, you really are getting the concepts of an accrual concept and cash concepts, because what we're doing is we're converting from an accrual concept to a cash concept. And when we do it in an indirect method, we're doing that indirectly, which is kind of conceptually difficult. So if you're able to do the steps, then that's really good. If you're able to do the steps and explain those steps, then you have a really good understanding, and that's good practice to understand the accrual concept, what the accrual concepts are, and how they compare to a cash concept. So the way a statement of cash flows will be created generally is that we'll take a look at the financial statements, and then we'll put a worksheet together, the worksheet being over here, and then we'll take that worksheet and we'll create the statement of cash flows from it. So that's going to be our strategy, that'll be our process. Notice that first of all, the statement of cash flows is a beginning and end. It has a beginning and an end, just like the income statement. It's over time, because we're measuring cash flows over time. The funny thing about a statement of cash flows is we will do that using basically balance sheet accounts. And that the reason that's fun is because the balance sheet accounts are going to be as of a point in time. So the balance sheet accounts are as of a point in time. We're using that to create something that has a beginning and an end, such as the income statement. So the reason we'll do that is because we have a balance sheet. We'll be using the beginning point in time, which is the same as the end of the prior period. In this case, the end of the last year, 20x4. And we will take the current balance sheet amount. So we have a comparative balance sheet here as of 20x5 in this case. And we will then look at the difference. The difference will be the change. So obviously, if we're looking at the end period here for cash, 123,450 compared to the beginning of cash, 61,550, then the difference in that, in essence, is the change. So that's the whole story. That's like the big picture story of what happened to cash. Well, that's the change in cash. Of course, cash went up and down and whatnot. That's more detail in the story. But in essence, we have that change in cash. That's going to be our, towards the end of the cash flow statement. That's the end of our story. We're going to kind of back into what happened. Why do we have this change in cash? First thing we're going to do that is basically convert the already converted balance sheet back into kind of like a trial balance. And this is really good practice to do because we have practice going from a trial balance to creating the financial statements. So going from a debit and credit trial balance to creating the financial statements, it's good practice to go back the other way because now we're going to take basically the plus and minus financial statements, plug them back into a debit and credit format so that we can use that worksheet to then create the financial statements. So this would be the first step. I'm going to remove the subtotals. We're going to take the plus and minus format, convert it back into debits and credits. So for example, for 2015, we're just taking this number here. That's where the cash is going. We're going to take the accounts receivable. It's going to go back here. We're going to take the inventory. It's going to go here. We're going to take the prepaid expenses. Those are the assets. It's going to go here. We eliminate the total. We're not going to total up here. However, that's a good checkpoint. We can add these up. And if those add up to this total, we're doing good so far. And then we're going to keep on moving on to the next account. Equipment is going to go here. Accumulated depreciation. Notice there's no negative here, but it says less. So that's a plus and minus statement. We need to convert that to a debit and credit. We will then, I'm going to represent the credits with brackets here. So I'm going to put bracketed 110,750. Now, a lot of people will not do that because that's a common error to mess things up if we're doing things quickly. If we do our check figure here, we would say, well, it's this minus this should equal this check number. So we'll be able to check that. Or we can say this plus this plus this plus this plus this minus this, which we can highlight if it was in Excel, should equal our total assets. And if we do that, we're doing good so far. Then we would keep on moving on. Accounts payable, credit. So it's a positive number here. We're represented it as a credit on our worksheet. And then we've got the short term. That's here, credit. We would add the two credits up, adds up to our subtotal. We will not include the subtotal, but that's a good check figure. Then we've got the long term. Here's the long term credit. We have the common stock. So common stock is going to be a credit. We have the retained earnings. It's going to be paid in capital, a credit. And then we have the retained earnings, which will be a credit. And once again, we can check and see if this is in balance by saying the debits minus the credits should then equal 0. So the debits are positive number, credits are negative number. That's how we'll represent this in a shortened worksheet, limiting the amount of columns we will need in order to make the worksheet. And of course, we'll do the same thing for the 2000X4, pulling these numbers in the same fashion. And if we do that, then the debits and credit for 2000X4 will add up to 0. If the debits and credit for 2000X5 add up to 0 and the debits and the credits for 2000X4 add up to 0, we'll then take the change for all those amounts. So 2000X5 is 123,450 minus 2000X4, 61,550 means there's a change, there's a difference of 61,900. We'll do that all the way down. We'll take the change all the way down between these amounts. And if this adds up to 0 and this adds up to 0, and then we took the change of all those, then that must add up to 0. And that's what we'll be working with. So now we're going to be working with this. This are the numbers that we will work with in order to create our statement of cash flow. Now, once we have this, what we're going to do is we're going to take these numbers and we're going to find a home for these numbers. We have a basic statement of cash flows on the right-hand side, just an outline of it. The major piece of the outline you want to take a look at is we have the cash flows from operations, the cash flows from investing, cash flows from financing. Those are the three factors of the statement of cash flows. You want to memorize those. And our question then is, if we just go through all of these accounts, we need to find a home in one of those three sections and plug them in there. As long as we do that, then, as long as we find a home for everything, the total will basically add up to 0, obviously, because if we found a home for all these and we have them going the same way, the same sign, whether it be plus or minus over here, then it has to add up to 0. So what we're going to do is we're going to find a home for everything except cash. Why? Because cash is our ending number. So we're going to find a home for all this stuff. The cash balance is going to be down here, the increase in cash. So if we find a home for everything except cash here, and we subtotal all that up and add that up, then it'll add up to the change in cash, which is what we're looking for when we're talking about the flow of cash. So we're going to talk about what the cash flow is in terms of the cash flow from operations, the cash flow from investing, the cash flow from financing. We're going to go in systematically one by one in everything, every change in every account on the balance sheet except cash. And then if we add those up, we will then come to the change in cash. That, of course, is our check figure. If that doesn't happen, that's like us not being in balance and we have a problem. And we're going to set up a system so that we reduce the number of problems that we have as we go through. The first thing we're going to start off with is the net income. Now this has to do with the difference. I want to talk briefly about the difference between the direct method and the indirect method. So the cash flows from operation is basically just taking the income statement and converting it from an accrual basis to a cash basis. If we thought about that, the most logical thing, if I was going to ask someone, could you convert the income statement from a accrual basis to a cash basis? What they would probably do is say, well, yeah, we would then try to figure out what income is or revenue is on a cash basis. I would convert revenue to receipts from customers. And all the expenses, we would convert expenses from an accrual basis to a cash basis and say all expenses are cash paid for expenses. So then we would say, you know, cash received from customers minus expenses that were actually paid with cash gives us the net income on a cash basis. So that would be the direct method in essence that we would do. We're going to use the indirect method for a couple reasons. The main reason is because oftentimes generally accepted accounting principles and other regulations require it, even if we use the direct method. So therefore, a lot of companies will use it. And because of that, most likely, the indirect method is widely used. So it's going to be used far more, probably because of that. Second reason is that we already figured out net income. I mean, we figured out net income. It might be a lot of work. It could be more work, we would think, to basically recreate the entire income statement on a cash basis. It might be easier for us to say, hey, let's take what we have now. We already figured out what net income is and like back out whatever we need to back out in order for us to get to net income on a cash basis. That's basically what we're doing. So the direct method is good. I've worked in firms that use the direct method. I think it's easy for us to explain the direct method to clients, but the indirect method is far more used widely. And if you can understand the indirect method, that really gives you an understanding of the relationship between the accrual and cash basis, because we're kind of backing in indirectly to these changes. So it's good to think through. So the first thing we'll start with is net income. And the first question is, well, net income's on the income statement, and we're talking about changes in balance sheet accounts. Let's go to the income statement and find what net income is. And I'm going to try to find a home for all of these first. Remember, our goal is to find a home for all these changes. And so I would like to find what net income is as it relates to a change in a balance sheet account. So what is net income? We can think about this as basically these trial balances are basically post-closing, meaning there's no income statement here. This is just the balance sheet. So the income statement has closed out to the balance sheet. Where does the income statement close out to in a corporation? Closes out to retained earnings. Therefore, that retained earnings amount here, this increase from 125.5 to 230 must be partially due to retained earnings. Net income, mainly due to net income. So that change in retained earnings is probably net income. So and note that in this worksheet, I'm always going to flip the sign. So that's just going to be a conformity of this worksheet. So whatever the sign is here, this is a negative indicated by the brackets. We're going to flip the sign over here. So we're going to start with net income, which is a positive 104,500. So what happened here is that retained earnings went from 125.5 in a credit up to 230 credit. So we have this 104 change. We're going to assume 104.5 change. We're going to assume that that is net income. Now, if I go to the income statement, which I'm not going to do now, if I go to the income statement, I may have a number that's different than the 104.5. It might be a different number. So I'm going to recognize that and highlight that and say, you know what, I'm going to look at the income statement later, and there might be something else in retained earnings. It'll be easy for me to figure that out. I can go to the general ledger and see if there's anything other than net income posted to the general ledger. There's only going to be a few things posted to the general ledger for the retained earnings, but I don't want to start parsing out this number now. So you might ask, what else could be in there? Dividends could be in there. So if we pay dividends, it might be affecting retained earnings. But again, I don't want to start breaking these numbers up into multiple different numbers. I want to first find a home for these numbers, then recognize the breakout of those numbers in a systematic way. So recognize that that might not be net income. That's okay. I know it's part of net income. Going to go back to it. We will fix it at a later time in an efficient way. So then we're just going to go down the list. So we're going to skip cash because the ending thing is going to be cash. That's going to be down here. And we're going to go to accounts receivable. So accounts receivable went from a debit of 80,750 down to 77,100. So first question, is that going to be a cash flow from operating, investing, or financing? One way to think about it is we can think that what's going to be the other side of a journal entry that basically increases accounts receivable. Why does accounts receivable go up? When we make a sale on account, we debit accounts receivable and we credit income, revenue. That means the other account is a revenue account, which is an income statement account. And that's one way you can kind of think of that. Well, that means it must be operating, because the operating activity has to do with us changing the income statement from an accrual basis to a cash basis. So we're backing into the income portion by looking at the change in the balance sheet accounts, and the change in the income statement account related to accounts receivable is income, revenue, which is an income statement account. Therefore, it must be going in the cash flow from operations. Also note that if we look at the cash flow from operations, we've got two sections here, and one section is generally called changes in current assets and current liabilities. So basically all changes in current assets and current liabilities, including accounts receivable, would be in this section within the operating section. Now then there's the question of, does it increase or decrease the net income from operations in this case, if we were thinking about a cash basis? Now there's a couple ways to do that in terms of a cheat sheet. One is that in terms of this worksheet, we're just going to flip the sign on everything. So if that's a negative, I'm going to flip the sign and make it a positive. You don't even have to think about it because that's the way the worksheet works. Other way, you could think about it in terms of just having a cheat sheet being brackets mean that we're going to decrease it if it's an increase. So that seems kind of funny, but if it went up, increase, then it's going to be a decrease, brackets, in this worksheet. And if it's a decrease, meaning it is here, it went from 80,750 down to 77,1, then it doesn't have brackets, meaning it's not a negative, it's going to be an increase here. So you want to have a cheat sheet in mind, but then you do want to think through it. If you're doing a test or something, or you're actually making a cash flow statement, you do not want to think through every time why the accounts receivable decreasing is an increase here. You just want to, memorize the rule, but it is good to think through it a few times. So we'll think through it one time for accounts receivable, then we'll apply the rule. So all assets will be the same. We'll go by this rule, and liabilities will be the opposite. So I'm going to think through this one time, and then we'll think the same logic applies elsewhere where you can think through it later if you so. So what we want to do is think about what happens when we have an increase in account receivable. What's the journal entry when we have a decrease in accounts receivable? So when we have an increase in accounts receivable, what happens? We made a sale on account. Therefore, people owe us more money, and the receivables go up with a debit, and revenue goes up with a credit. On the other hand, when we decrease accounts receivable, what happens is we receive cash and we reduce the receivable account. So if we think about that in terms of the general ledger, we're going to debit accounts receivable here on this transaction and credit accounts receivable here. So when accounts receivable goes up, what's happening to the income statement is that we're increasing net income. Net income is going up because the income went up. Net income is income minus expenses. But no cash was received at that time. So under a cash basis, we're increasing the net income when we shouldn't be, because on an accrual basis we should, because that's when we earn the money. On a cash basis we shouldn't, because we haven't got any cash. Therefore, if over the long term, over the entire year, this journal entry happened more than this journal entry, then that means we recorded more sales in which we had not yet received cash than we received cash. Therefore, we need to decrease net income if we're converting from an accrual basis to a cash basis. If, on the other hand, this entry happened more than this entry, that means that over time the receivable would have gone down. And when it goes down, that means we got cash, we reduced receivable. We got cash, and we're not recording revenue in this time period in which we got the cash. Because under an accrual basis, we recorded last time period, when we earned the revenue. So at this point in time, under a cash basis, we got to say, well, we should be increasing the net income under a cash basis if accounts receivable goes down, because this is happening here and we got cash. So we have to record the revenue at the point in time when we got cash. So that's the reasoning behind it. But again, you just kind of want to learn the rule here, and the rule will be either in the worksheet that you make, or you want to have kind of like a cheat sheet like this. All right, so then we're just going to go down the list. We got inventory next. So inventory is an asset. It's going to follow the same rule as the receivable. We know the other side of inventory oftentimes is we're going to sell the inventory. Therefore, we're going to reduce the inventory. The other side is an expense, cost of goods sold. Cost of goods sold is part of the income statement. Therefore, the inventory is going to go into the operating cash flows from operating. And note that we can kind of see a cheat sheet on that, and we know that the changes in current asset and liabilities go in the operating section. So that means that this is going to go into the operating section. It went in 2014 from 257 down to 246. Therefore, we're going to follow our rule, and we're going to increase the statement of cash flows in the operating section by that change, 10,100. And again, this worksheet, we're just going to flip the sign. That's a negative here. It's a positive here. You can also see the cheat sheet here. An increase is going to be a negative. A decrease is going to be a positive if we're talking about assets. So as of now, the operating section, we started with net income. Then we're going to increase net income by this, increase it by that. That's what's going to go here so far. Well, let's keep going. And then we got the prepaid expenses. Same thing. It's an asset, and it's going to follow the same rules. It's a current asset. If we think about the other side of prepaid expenses, it's going to be, if the most common is like insurance, prepaid insurance. So the other side of prepaid insurance is insurance expense, which is an income statement account. Therefore, it's part of the operating activities. It's also a current asset, and therefore it goes into this section of the operating activities. It's going to follow the same rules as all assets in this section of the operating activities, in that, in this case, it's going from 17 down to 15.1. That means it's going to be added back for similar logic as the accounts receivable account. And also in this worksheet, we know that all negatives is going to be positive. We're just going to flip the sign on everything. So at this point in time, we've got the 104.5 in the operating, plus this, plus this, plus this. That's what's going to go here at this point in time. Let's move to the next account. Next account is equipment. Notice equipment is not a current asset or liability. So we got to think through this more deeply now. Is it going to be operating? Is it going to be investing? Is it going to be financing? And in this case, if we think about equipment, when we buy equipment, what's the effect on equipment on the journal entry? Well, if we bought equipment, then we're going to debit equipment and we're going to credit cash or some kind of loan, whatever we bought it for. Neither of those accounts, no matter what they are, is not an income statement account. And therefore, since the operating activity has to do with the income statement, it's not going to be an operating. So then we have investing or financing left over. And it's actually in investing. And this used to confuse me when it was in investing, because when I used to think of investing, I used to think of that's like stocks and bonds, and equipment's not investing. It's an asset. But when we think about it, obviously, when we buy equipment, we're putting money into equipment so that we can use it in order to help our purpose, which is to generate revenue in the future. So we are, in that sense, investing in the equipment to help us generate revenue in the future. Therefore, it is an investment. we can see that it went from 200 in 2000X4 to up to 110,750. So we're just going to make an assumption for now. I mean, again, I could go look at the GL and see exactly what happened. There's not going to be a lot of activity in an equipment account generally because we don't make too many purchases of equipment over the year if we look at the T account. But I'm just going to assume overall that we bought equipment. And we're going to assume, so we're going to say it's going to be cash paid for the purchase of equipment. And notice what I'm assuming is we paid cash for it. And very well may not be true because, you know, if I bought a lot of equipment, we might have financed it, and very likely that we did. But again, I don't want to start parsing off this number because it could get very complicated when we start looking at different pieces of equipment we purchased and how we financed it. This number could get split up in very complicated ways. And before I do that, I want to find a home for the whole numbers and then go back and start parsing them up. So I'm going to make it yellow. I'm going to say, yeah, I recognize that it's very likely that I did not pay cash for that equipment, but I'm going to, you know, think about that at a later time. So then we're going to move on to the accumulated depreciation. So once again, not a current liability or asset. Therefore, it's not necessarily in the operating activity. We're going to have to think about it a little bit deeper. And we're going to say, well, what's the journal entry that would be affecting accumulated depreciation? And that's the one where we're going to depreciate the equipment. In this case, we're going to debit depreciation expense, credit accumulated depreciation. Therefore, this increase here, the other side of it is an expense. It's depreciation expense. So that's an income statement account. So it is going to be in the operating activity, even though it's not part of the current assets and current liabilities, because the other side of it is depreciation. So rather than us calling it, this is going to be the change in accumulated depreciation, we're going to recognize what the income side of that is, what the income side of that change is in this case, which is just depreciation. And we're going to put it up here in this subsection, which says income statement item not affecting cash. What does that mean? Well, it means that within this net income of 1045, there is depreciation, which had nothing to do with cash because we debited depreciation expense and credited accumulated depreciation, which has nothing to do with cash at that point in time. At that point in time, no cash was affected. At that point in time, depreciation expense decreased net income, and on a cash basis, it shouldn't have. Therefore, that 1045 under a cash basis needs to go back up by the depreciation of 15,750 because we put it down according to an accrual basis, and under a cash basis it shouldn't have gone down, so it's got to go back up. So now we've got under the operating, we've got the 1045 plus the 15 plus this plus this plus this. That's what this is going to be so far. So let's go to the next one. Next one, we've got accounts payable liability. Now, note, once again, it's a current liability. So we kind of know it's going to go in the operating section right here because it's in that subsection. If we think about what's the journal entry for accounts payable? Well, we could think, well, we bought something like an expense maybe on accounts, so we would debit some kind of expense, credit accounts payable, and therefore the expense is an income statement account, and the income statement account has to do with the operating activities, and therefore it should go in the operating activities. And you might be saying, well, what if we bought like inventory, which is an asset? We debit inventory and we credit the payable. And that's true, but you know, even inventory ultimately is going to be expensed in cost of goods sold. So in any case, it's the easiest way to think about it is that we bought an expense and debit accounts payable. And if you think about it that way and you want to think about liabilities, you can go through the same reasoning that we did for the accounts receivable and try to think of why it's going to follow these rules. What are the rules going to be? Well, if it went from, first of all, the rule is it's a positive number here. We're going to flip the sign and we made it a negative here. That's the rule for the worksheet. Second of all, we know that it went from 2000X4 102 down to 17,750. And if it decreases, it's going to do, we're doing the opposite of all the assets. It's going to decrease the cash flow from operating, or cash flow from operating here. Therefore, it's going to be a negative. Now, again, you just want to know the rule. Here's the cheat sheet on the rule. It's going to be obviously the opposite of all assets. And but if you want to think through it a few times, but have the cheat sheet there if you're going to make the problem or take a test on it. So now the operating activity has the net income plus this, plus this, plus this, plus this, minus this. That's what's going to go here. Let's move on to the next account. Next, we've got short-term note payable. So a note payable, obviously not, well, it could be a current liability. So you would think actually it could go there, but it's a note payable, however, and when would a note payable be affected? We're saying it went from 10 up to 15, from 2000X4 up to 2000X5 by 5,000. Why would we owe more money on a note payable? Well, maybe we borrowed money, and if that happened, we would debit cash and we would credit the note payable. And that has nothing to do with the income statement, and therefore wouldn't be in the operating activity. Now, notice we could have borrowed something other than cash. We could have bought something and financed it. But even in that case, it wouldn't be an operating activity. So once again, I'm going to make an assumption. I'm going to say, well, it's either investing or financing. Clearly, if we're loaning and borrowing money, that's actually a financing activity. It's going to be down here in the financing section. And so we're going to follow our same rules. I'm going to flip the sign. It's a negative here, so I'm going to make it a positive here. And the logic being that, well, it went up. Therefore, I'm going to assume that we borrowed cash. And again, I'm going to make that yellow because, I could have financed something. I don't know what really happened. I got to go to the GL and pull out whatever happened in order to figure that out. But before I go pulling the GL and whatnot and parsing this number up, I'm going to make the easy assumption first, just so we can find a home for all these numbers. Then I want to make sure that we are in balance or we are tied out to the change in cash, then go back and parse that out. All right, so let's go to the next one, where we have the long-term note payable. Same concept, right? If it went from here up, then we're gonna assume we borrowed more money. We're gonna debit cash. We're gonna credit the note payable. And once again, that has nothing to do with the income statement. Therefore, it has nothing to do with operating. We are, again, financing. We're borrowing money. So that's going to be down here in the financing. And again, I'm going to make this assumption. It's very likely that something else happened. I'm going to go look at the GL. I'm going to figure it out, exactly what happened. But if it went from here up, then I'm assuming that we borrowed cash. Now, if it went down, of course, I would assume that we paid cash on the note. So it's going up. I'm going to assume we borrowed cash. Could have been something else that happened. We're going to go in there. We're going to dig through that. There's not going to be too many transactions in the notes payable general ledger, hopefully, because we didn't borrow money all year long. Unlike the cash account, obviously, would have a lot of detail in the GL. So we're going to parse that out later. I'm going to make it yellow. I'm going to say, yeah, I know that we might have had something else going on there, but we're going to find a home for all these accounts first, going to be in balance, then we'll go back and parse those out. All right, then the next two, I'm going to put these two together, common stock, paid in capital. Why? Because note that common stock is the issuance of stock. That's kind of like the investing of the stock. Now, when we think about common stock, there's two kind of things when we buy common stock. Usually if we buy common stock on the stock market, we're not buying it from the company, we're buying it from other investors. It's not the company issuing stock. If the company issues stock, then the company's the one receiving the money. That doesn't happen all the time. So the common stock may not change a lot from year to year. Of course, in an example problem, we want to have an example of the common stock changing so we can put it in the example problem. So it went from 200 up to 215, meaning we issued stock. So we issued more stock, got more investments in the company in that way. Now we also have an additional paid in capital. Why? Because remember, when we issue stock, we might issue it at a par value, which is just like a made up value, so that we can have an even value to the amount posted in the common stock. However, when we sell it, we're going to sell it for whatever we can, which most likely will be higher than the par value. So the additional paid in capital is the amount of money that we issued the stock for above the par value. That's why these two are basically related. That's why I'm going to record them related. So we're going to make the assumption that we debited cash. We sold common stock for cash. So, and that means that the change, this 15 and the 30, is that happening. So neither part of those accounts are part of the income statement. Doesn't have anything to do with operation. It's going to be financing. Why do we issue stock? Because we're financing the company. We're trying to get money into the company through a financing process. And therefore, we're going to assume, once again, that cash received from issuing of stock is the effect here. I'm not going to make that yellow because I happen to know that we don't need to dig down on that. So it's going to go up, and therefore we're taking that change, 15 to 30, flipping the sign. So that 45 negative, flipping it to a positive. We received cash. So in the cash flows from financing, we have this plus this plus this. That's what's going to go here so far. Now, that's what we have. So now we found a home for all of these except cash. And therefore, we can add this up and see if the difference adds up to cash. If we have all these going the right way, remember we flipped the sign on all of these. Therefore, if we flip the sign on all of these, it should be equal to the 61.9. Let's see if that's the case. We got the net income. This is the cash flow from operations. Net income plus this, minus this adds up to this 51,650. That's the cash flow. That's how much cash we have received from operations. If it was a negative, we would have cash used from operation. Cash flows from the investing activities, all we have is this 62,250. It's a negative, so it's a decrease. So we're going to say net cash flows from investing activities is a decrease in cash flows from investing activities. 62,250. Financing activities, we got the 5 plus the 22.5 plus the 45. So we borrowed money in this case, it looks like, and we issued stock. So it's all increases. We're going to add those up, 72.5. Then the 51,650 plus the minus the 62,250 plus the 72.5 add up to 61.9. Yes, that adds up to our change in cash. So we are in balance so far. So that's great that we're looking good so far. However, of course, we have these issues where we're going to go back to some of these accounts and say, you know, we recognize that there's some issues that we're going to figure out and find out systematically how to fix those and see if there's any changes that need to be made to certain accounts. Now, the first yellow account we had was actually net income. That's where we started. We started off with an account we were kind of questioning over, but we didn't want to parse out the account at that time because we wanted to go back and do it systematically. Now, we know we are in balance here. What we're going to do, I'm going to do something similar to kind of like an adjusting trial balance and say, let's make an adjusting column and let's increase it similar to a debit and credit. Make sure that we increase and decrease something so that we end up with something. Notice this is just adding up this column and this column that is in balance, meaning that we still equal the change in cash 61.9. So if we go back and say, hey, net income is wrong, I know what net income is. It's this 158,100. So if I start with that, then I have to change it from the 104.5. It's going to go increase by the 53.6 to that number. So I got to increase. So I got to increase net income by. If I do that, then it's going to throw me out of balance. So what I got to put the other side somewhere. So we got to figure out what that change is. Let's do it systematically. Well, we're going to parse out this number between the two components. If we go look at the GL, it would tell us the activity. If we look at a book problem, then it'll give us something like this. It'll say E says that declared paid cash dividend. We got to just know, well, cash dividend, that means that a journal entry would look like this. I mean, if we paid a cash dividend, that means that we debited the retained earnings because we're taking it out of the retained earnings. That was the difference that we used to come up with this 104.5 that we assumed was all net income. And then we credit cash. So that's the journal entry. This would be now let's think about that journal entry in terms of a change to our cash flow statement. What two accounts, what two names on our cash flow statement can relate to this journal entry to make us have an even adjustment? And of course, net income has to change. So we know that net income has to go from 104.5 up by that amount in order to get to our net income, which is on the income statement here. And the other side then must be the cash we paid for the dividend. So the cash paid, that was paid for the dividend. So we're going to create a new account. I'm going to say cash paid for dividends. I'm going to put that as part of the financing activities, which is where the dividends will go. And it's going to go from 0. And now we go, it's a decrease in cash, decrease in cash. So now we had a change. We had a change to our operating activities, went from here to here. We had an equivalent change down here in our financing activities. We're still in balance. So that's not going to throw us off. We're good. I see exactly what happened there. Let's go back and let's go find out our next difference and see what that is. So the next one is depreciation here. So again, what we would do is we look on the income statement and say, well, is depreciation on the income statement equivalent to this 15,750? Because, we got to that depreciation by looking at the change in the accumulated depreciation, which is usually the recording of the depreciation expense. That's how we came up with this 15,750. But if we look at the accumulated depreciation, there might be something else affecting it. So we have to compare that. We could first compare this to the income statement. Say, hey, what's depreciation expense on the income statement? Well, it's 38.6. That's not the change in the accumulated depreciation. Well, that means that if I was going to take it from the income statement, then I would have to put this 38.6. That's what should be there. That's what we have to increase net income by in order to adjust for the depreciation expense that we reduced it by. And if I was to do that, then I would have to increase this number by 22,850 to bring it up to that 38.6. If I do that, well, that's going to throw me out of balance, so we have to do something else. So let's look at the GL and think about, okay, what's in the GL related to accumulated depreciation other than just recording depreciation expense? What else could affect it? In this case, we sold equipment. When we sell equipment, we also have to account for the accumulated depreciation that is on the books in relation to that particular piece of equipment. Now this one can get a little confusing. If you can get this one, then you have a good understanding. Note how this one can really throw you off if we started out with depreciation instead of backing into depreciation. Because if you're at this point in time and you go to your supervisor and say, hey, this depreciation is throwing me off, but I know that I'm on track, I've got everything in balance, but this one thing, I got to figure out how to adjust this change to account for this journal entry related to the depreciation. We can dig that out, rather than going in and saying my entire thing doesn't work and I don't know what. So if we figured out this journal entry, what would be the journal entry related to that? We can go into our GL, we can double click on the GL in our software, and we come up and we say, okay, this is what happened. We sold the equipment, we got 26,050 for it. That's the cash related to it. We took the equipment off the books. So that particular piece of equipment cost us 51. We had to take that off. Equipment's a debit. We credited the equipment to take it off the books at 51,000. Then we also had to take the accumulated depreciation related to the equipment off the books, which is what most people often forget. And so obviously all equipment has this other account related to it, accumulated depreciation, which we must take off the books. So we got to figure out how much of the accumulated depreciation is related to this one particular piece of equipment. Make sure to take that off the books. And then the difference is going to be the gain or loss, in this case, a loss. So we'd have to dig out this journal entry and say, okay, that's the journal entry. How can we then convert this journal entry into basically what we need in terms of these accounts up here, so that we have something that's in balance, that will keep us in balance. So we know that we have to fix the depreciation account here. So we know that the depreciation is going to be going up by the 22,850 in order to equal the 38.6, which equals what's on our income statement. Then we have the cash received from the sale of equipment. Now, I mean, we got cash up here. We can see the 26 that we received, and we didn't record that anywhere. We sold equipment. We didn't put that on our cash flow statement. So we got cash from the sale of equipment. And if we received cash, remember, equipment is an investment. Therefore, it's going to go in the investing activities. We're actually going to create a new line. You might have been wondering why there was a blank line there. We're going to create a new line called cash received from investing activities. We're going to put that in here. I'm going to add that 26 here. That's going to be part of it. So that'll be the other piece, part of that. Now this equipment, this credit to equipment, where did we put that? Where did we put the change to equipment on our statement of cash flows? We put that into cash paid for the purchase of equipment. But this part of that decrease had to do with this sale of equipment. So this 51,000 wasn't part of the cash paid to purchase equipment in this case, and that's why this 51 is going to be part of this line item here. So this was the original change. We're gonna put that 51 negative and say that if we paid all cash for the equipment that we purchased, we must have paid 113,250 for it. Now again, that might not be the end of the story, because we could have financed part of that, or there could be other transactions involved, but we're going to make that adjustment here. And then we have the final loss. Now notice that this loss, if it has to do with equipment, we want anything related to it to be in the investing activity. And under the income statement, this loss here, so we've already recorded the cash related to this in the investing section. We don't want any of the gain or loss or related to it in the operating section. And when we recorded this loss, it was recorded in the net income in the operating section. Therefore, up here we have this, we had this loss included in this 1045. That's where this piece is going to go. We're going to create a new line, which again, you probably were wondering, why is there like a blank blue line there? We're going to say that, hey, we brought this net income down by this loss, and we don't want that loss related to the equipment here. We want anything related to the equipment to be in the investing activity. Therefore, we're going to increase the loss here. So that's the adjustment. So this idea here being that we're still kind of in balance. We're not dealing with debits and credits, but we're making this adjustment in such a way that we can figure it out and still remain in this change in cash being the same. And notice I'm checking this figure down here because this figure should be pulling over here as well. So I'm just looking as of this line item at this time right now. All right, so then we have the next item that happened. So we have the purchase of equipment. We're taking a look at this next yellow item, which we had a yellow item for, and we're going to dig down on that and say we had a purchase of equipment. Is there anything else related to that in basically the equipment account? And here we had a purchase of equipment which cost $113,250, and we paid cash $45,250 for it. So what must have been the journal entry? We can go dig through the GL, find the journal entry, and we must have debited cash $113,250. I'm sorry, we debited equipment for the cost of equipment $113,250. We credited cash. That's how much we put down on the equipment. Then we financed the rest for the $70,000. So then the question is, well, how are we going to convert that to basically the accounts over here in order to make this cash paid for the purchase of equipment what it should be on a cash basis? And part of that is going to be here. Now, remember last time we brought it up by the $51,000 from the last transaction, and we were at $113,250 in this amount. And that would be how much cash we had paid if we had paid all cash. Now, this journal entry is saying we didn't pay all cash. We financed part of it, and we only paid $43,250 in cash. Therefore, we're going to bring it down by the 70. So now we're adding to this sale is the $51,000 from last time plus the 70, so that we end up with the cash that was actually paid for equipment, which was the $43,250. The other side of this is, remember what we had was the change in the debt down here. It was the $22,500. And part of that, now that we dig down into it, had to do with this this debt change from this transaction. Therefore, the other side of this is going to be going to the cash paid for long-term debt. And we had to actually flip the name of the notes. Now we've got, it was cash received. Now we realize that it's a cash payment here. So we flipped the name and said the 22.5 minus the 70 brings it down to what it should be, which is the 47.5. So now if we look at the final process here, notice that last time we basically have been stopping at the change in cash, the 61.9, the 61.9. And that of course adds up to the 61.9 up here, the change in cash. So remember, that's what we found a home for everything, and we looked at the change in cash. Now, when we think about other financial statements, we don't see the change in cash on the financial statements if we only have the financial statements as of 2000X5. So we don't want to end the cash flow statement as the change in cash. We really want to end it with the ending cash balance. And that's easy enough to do. So, right, we're going to say, well, if that's the change in cash, we're just going to say, hey, let's just add that to the beginning cash balance, and we'll back into the cash balance as of the end of the time period. So really, this is our verification figure. This is the easiest one for me to use when we are creating the cash flow statement. But of course, when we're comparing the statements, we want to end with the amount of cash at the end of the time period. So if this is the change and we add to it what was in there at the beginning, which is this number, then we will end up with the cash flow as of the end of the time period, that point in time on the balance sheet, so that we can compare the cash flow to the balance sheet, which would be equal to this number here. And again, if we do this change, notice what we have now is we started with these. This column represents us finding a home for all of these numbers without thinking about parsing them out into their separate parts. This column represents us parsing them out, going through the thought process and parsing them out in a systematic way. And note how some of those were pretty complicated for us to parse those out. If we try to do that as we go, it is very easy to get out of whack and then get to the end of the problem, not to be tied out to the change in cash and have no idea really exactly where the problem is at. So I recommend putting together a system so that you can then think through those problems and take it to a supervisor or something and have a very pinpoint place at where you are out and try to be able to explain as clearly as possible what the problem is to save, as much time as possible. Then note that we can have the change over here that will result. So our ending numbers are here. So here's our ending numbers. Here's our cash flow that we can then plug into a cash flow statement, or just, hide these lines here. These are our ending numbers. Here's our the names of the items within the cash flow statements. Again, if you're working a problem in cash flow, there's two types of things you're going to have to know. You're going to have to memorize operating, investing, financing. And if you know which items go in which section, you can get a lot of points on that. If you're actually going to create a cash flow statement, then you really want to come up with a systematic way to do it, because it can be somewhat difficult to make sure that everything ties out towards the end. So we're now able to define a statement of cash flows, create a statement of cash flows, explain a process of creating a statement of cash flows designed to limit mistakes, define the indirect method.